market isn't downbeat on this because came in line with expectations and kind of just further shows that inflation is moderating. Those rate hikes are working, and maybe it seems like if we're not at the end, we're pretty close to it.
Yeah, the data yesterday, too, a little bit soft. Some of the housing data weakening, and then the GDP revision had some soft points. So 2 days here where the reflation, economic strength narrative, and some of the risks that come with it are ebbing a little bit, market getting some relief. Though, to your point about the difference between the core and then the top line number generally, one going down, one going up from the previous. A lot of this does hinge on how we think policymakers are going to respond to energy, whether or not that really does come into their mindset, how true of a following of core inflation do they have, and then also how true of an ambition do they have to still get it down to 2%. So it seems like Powell's letting us kind of float there, but I think the direction they're encouraged by, but it probably needs to pick up the pace some more because we're still well above where they say they want to get to.
And, you know, we're going to talk about this government shutdown. If the government does shut down, which appears likely, we won't be getting some of those key government inflation and job statistics that the Fed so heavily relies on. Obviously, the data is backward looking, but they say that they're data dependent. So if we don't get those figures, the Fed is going to have to be obviously, deciding on policy without them, which should make for an interesting situation. So I think it's all something to consider as well.
Yeah, I'm kind of thinking the market might like a government shutdown because, to your point, you shut down, you get no more data, and if the data's been causing a headache for markets, I think stock investors might just be saying shut it down.
I don't know. There are so many broader economic implications, and if I was one of these essential workers that would have to work regardless of a shutdown and just not get paid, I can't imagine that I would be very happy about that, nor would I probably be able to, be spending money like you otherwise previously would. But just to kind of hit on the key points there, it does look like a government shutdown is likely this weekend. The House is expected to take up a Republican stopgap bill to extend government funding today, but it doesn't look like House Speaker Kevin McCarthy has the votes that he needs to pass that. Now, they did pass several spending bills last night, but those wouldn't actually avert the overall shutdown. And the Senate, of course, is working to advance a bipartisan stopgap bill that would keep the government open through November 17th and provide some scaled back aid to Ukraine and disaster relief. But House Speaker McCarthy hasn't said whether he would try to actually cut a deal with the Democrats if conservative members of his party don't bring down this stopgap measure. So the expectation is that could take until Monday to pass anyway, and funding is expected to expire Saturday at midnight. So it looks like we are heading into a government shutdown this weekend. In terms of the economic impact, I will say there are nearly 2.2 million Americans who are federal employees, 1.3 million active duty troops who would all be impacted. As I said, essential workers still will have to go to work. They just won't be getting paid. Other workers will be furloughed. Airlines, there's a lot of talk about, them being some of the hardest hit. The U.S. Travel Association estimates a shutdown could cost the travel industry $140 million a day. So if you're traveling and, after, say, Sunday, you have to know that the people, at the security lines and the people helping you in the airport are working without getting paid. I can't imagine that sentiment will be all that good. Just in terms of the broader economic impact, Goldman Sachs was out with a stat that a shutdown would subtract 0.2 percentage points from Q4 GDP for each week it continues, and that would be the same in Q1. So something else to consider there. And then, of course, House Speaker McCarthy also faces the fact that he could get voted out if some of the conservative members of his party, if he does strike a deal with the Democrats and some of the conservative members of his party decide, they've threatened to oust him. So a lot of, economic and other implications there. And it just seems like another headwind for this market that has been really up against quite a bit.
My thesis that stock bulls are going to love a shutdown I think, got stronger. Negative impact on GDP, no inflation data, market rallying right now anyway, though I'm less confident my travel this weekend is going to go smoothly because we won't be shut down. We'll be at Market Drive in California. Thanks, Caroline Woods. A further look here at what's happening in the government potential of a closure. Renita Young here with me in the studio. All right, well, at least we got one inflation print underway before the government shuts down, Renita. We've also got some earnings too. And I know it's risk on this morning because Nike's going wild to the upside. First time we've seen this in months.
It is. And this month in particular, Nike shares were down substantially, but they're rejoicing this morning because the company had better than expected earnings and revenue that some are characterizing as in line, though it slightly missed the Zacks estimate. I feel like people are still happy about the overall sentiment of what happened with it because the company also managed to chip away at its inventories and
saw that.
Absolutely.
Down like 10%, right?
Down 10% year over year. Adjusted earnings were 94 cents a share on revenue, just shy of the Zacks estimate. It came in at $12.94 billion. Direct-to-consumer sales were up 6% in the quarter, and the company managed to reiterate its outlook as well. All in all, many are saying this is excellent, but when we look into the numbers, it's really better than feared because people did not have that many high hopes for Nike. There was a lot of speculation that China would be a drag on Nike's sales because it does have a huge consumer base in China, but the company expressed that it's confident in China whether or not the macroeconomic environment actually looks or performs the way that people are hoping that it performs. So all in all, a pretty good earnings season session for Nike that's sending shares wildly higher today. Analysts having a little bit of a mixed reaction this morning. Deutsche Bank raised its price target to $125 a share from $122, keeping a buy rating, said that revenue was in line. Barclays cut the price target to $119 a share from $124, keeping an overweight rating, saying that sales were slightly missing expectations, but that the inventory is clean. So all in all, analysts still bullish on this stock, but with some notes about a few of the areas of the report.
That's what I noticed from looking at a lot of that commentary yesterday, was that for the most part, sell-side analysts are still pretty hopeful that Nike can turn it around. And when we got these numbers yesterday, George and I looked at it, and it just didn't seem really in line with some of the negativity around the sentiment. Like, I get that it's not a blowout great report. It's not the best thing we've seen from Nike over the last couple of years. But given how downtrodden the stock has been, how negative it's been, when plenty of other things in the athleisure category have been doing fine, that it feels like the market's kind of getting a little bit more reasonable in its assessment here, because it's not a bad report.
No, it's not a bad report. And to your point, management had been giving commentary that suggests that the environment is much better than what it was expected to be, than what analysts have been saying that it was. So, I mean, for now, we'll have to trust what they say and then see the proof of it later as well.
No cut to the guidance, important. The fact that they kept that, because we did see for Foot Locker, for Dick's, both of them reduced their own annual expectations. So Nike able to hold the line, I guess. Good enough for now.
Yeah.
All right, stocks up big. Thanks, Renita, for the update. That's the big earnings from overnight and into this morning. Nike up, stocks up, markets calm after inflation. Let's talk about the higher for longer environment, because that doesn't change. You're not going to see any major shift for Fed odds this morning, but you are seeing a shift in the tone as bonds are firm, dollar is down, volatility expected to start a little lower here as the NASDAQ leads the charge. Matt Rowe joins us next.
Good morning, September 29th. Hope you guys had a good morning, good evening last night. Let's see, this is the final trading day of September 2023. It's Friday, welcome. Sub up, like up, comment down, Happy Money sticks around. You can follow us on Twitter at HappyMoneyYT. Get on our Discord server. Link for those in the description. Discord desktop is not working right now. I haven't used the browser. It's pretty annoying. Oh well. Not that annoying, I guess, because it looks pretty much exactly the same. It's not like, yeah, anyways. Big gap up here on SPY, and yeah, PCE numbers this morning. Market liked it. Also, yeah, if you heard that news right there. So like we'll see. We have until probably midnight tonight before we'll know for sure if the government's gonna shut down. Which sometimes they wait till the last couple minutes. That's weird. Now my Discord won't even open on my desktop. Oh, it already is open. Here it's working again. Well, maybe it's working now. Yeah, okay. Discord is working. That was fast, man. Bad. Good morning, Bubba. 420s and some 420 puts it open. You don't believe in bears building liquidity by letting it rally up? Good morning, Guts. Morning, Sweet Lou. Been a while. Inflation push markets higher. When you're competing with interest rates, not really. The inflation that's been pushing markets higher is right here. Ever since they started printing money and just handing it out. That's the markets higher that from inflation that you see. That chart. 2020, 2022. About 8 minutes to open. Patient today. Yesterday was a good day. To rush anything. Liquor's got a little gap up. I don't know why. Doesn't mean a whole lot. You need thousands of percent now to get anywhere close to IPO. He's gonna get delisted at some point if it stays down here. Worst IPO performance ever. Buys up 0.68%. Let's see. I didn't recognize anything else on the morning gap up. Mind. PavMed. Nope. 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 GME is up almost 1%. We're opening pretty close to the top of this cup. This full cup. Get a little one here, a little handle. A bigger one here with a handle. Now we're up at this higher one. And now you can see we have all this liquidity to build another shoulder over here with this inverse head and shoulders. Data's out though. I didn't hear anything from Powell yesterday actually. I don't know how that went. Did we get a market reaction yesterday from it? A little bit bullish. Could get some pullback today and maybe a bounce. Could rally first too, since we could go a little higher for this cup. All right, let's see. GME, almost percent. All that volume yesterday. Wow. We had volume on that sell-off. Built just intraday bear flag. AMC, flat pre-market. Yeah, is up 2%. We're up here. Yeah, we could be getting this gap fill maybe next week. 480, 438. Which could still be retracement from this inverse cup. I don't think that's too far. Wish it was a gap down, huh, Sweet Lou? What kind of positions do you have? Mia's up 2.5. Peloton's up 2.25. Goes up 3. He's up 1.25. Fish did 3% yesterday. Oh yeah, it's below that support now though. Hopefully it's just a false break there. Yesterday's Engulfing candle is pretty nice. A little bit more volume. Bronco's starting to roll over here. See if it holds this inverse head and shoulders though. What's Kramer doing? Kramer's up 3.5 pre-market. An engulfing candle 2 days ago though, that's when I got stopped out. Yesterday it's trading well below that range also. 3% on First Solar. Nice bounce around Lucid. Alright, market is open. Back. Volunteers had a pretty big gap up. So I'll have a left shoulder to contend with. Or the bears. Nike had earnings, I think. Up 11% on earnings. Wait, not earnings? Yeah. Yeah, they beat 94 cents, beats by 18 cents. Revenue of 12.94 billion. Missed on revenue, only by a little bit, only by 60 million. So not much. Beat on revenue though, or beat on EPS. Small miss on revenue. Bad. Got Jeff Brand's gap up. Wicker went from 20% to 7% real fast. Where does this put GME? Still below the resistance. But it's only on SPX. How much time do you have? Neweggs up 5%. I'm going with a 5% gap up. Price target raises. Okay, I coming down here a little bit. AMC is up 0.9. Right in the wedge still. Got GME up 1.7. Now 2. Barbecue's down 5 at back to 10 cents. Might get a gap fill. Get a gap fill before we rally. Which would complete another handle. Thermal Capital says property's going to 0. I mean, there's not many people that say it's not going to 0. You asked greater population than outside of YouTubers and Redditors. Open Doors up 10. Blue Apron's up 133%. It's all about. Blue Apron to be acquired by food delivery firm Wonder Group for 103 million. The 82 million market cap right now. So maybe still some upside there on Apron. I bet we will. What in the world? Doing? GME back down a bit. Barbecue down 14% to 9 cents. Has a range now. Still stuck in this channel. It's pretty large though. You can see it's 100% move from the bottom to the top of it. Coming up there a little bit above VWAP. I almost just want to wait for that gap fill before going long. Be a nice trade if it works out that cleanly. GME almost red. 0.5%. AMC up 2.5, button up against the top of that wedge again. Need to hear some numbers from that Taylor Swift movie concert thing. Thought that wasn't a bad idea. Recording all the concerts and just making a recap almost of it. You get a bunch of people that actually went to the concerts that want to go see it for sure. You get people that didn't want to spend time or money to go to concerts to go watch it. And then I think it's like a pretty big premium. There's a flush off of VWAP on SPY. AMC up 3% now. AMC tried to break it. Break on there. GME back up 1.5. So this morning we had PCE, core PCE, advanced retail inventories, advanced wholesale inventories. 9:45 we have Chicago Business Barometer, and then 10 we have consumer sentiment. So I don't think 9:45 will be much, but 10 o'clock that consumer sentiment could be a bit of a catalyst. Birds is up 20%. Liquor's at 12. And a half on AMC. Back up to VWAP a little bit. Slowly filling this gap. It's a pretty big move actually if it fully gets a gap fill. But probably worthwhile the trade. That might be all we get. Bounce on the bottom of that channel. Breaking up out of the channel, maybe. Back to VWAP. The choppy bearish channel here. All right, 10 minutes, we're gonna get consumer sentiment. Fall there. Grab another there. VWAP test. Rejection. Starting to make this little inverse head and shoulders here and breaking out of this channel. There's VWAP. See if we can make a little cup here. Break on VWAP. That VWAP drop right there. That's weird. There's data in 5 minutes. Might exit one of these before then. Gonna wait for high of the day to exit and put a stop in the other one. But consumer sentiment could move the market. See, right up against that resistance now. Tighter and tighter. BBBYQ 1030 down 2%. GNS down 2.5. What you're seeing here, this is Weeple. The link for it in the description. Looking for a new platform. Helps me out if you use the link. That's pretty good. All right, 2 minutes for consumer sentiment. One minute. Get me high of the day first. Do it. Put a stop on one of these. Sell the other one. Probably get stopped out on one of them. There's a drop. I'm gonna close one of these. I'm gonna stop the other one if it flushes. Here it is. All right. Big reaction. Not bad. % on AMC. Vapor up 133% now. Even though the buyout price is higher than this, it's just interesting how it gets to a certain price and then just stops. GME 16.95. Is this the company that was on the news on our Trader TV? The NextEra Energy? I think so, NEP. Thanks. Firm's held up so well, it's crazy. Tesla's up 3. Well, we've got a little cup here. See if the handle bounces here and we keep rallying, or if we break through and hit a double top. I'll have that gap to fill down there, so not overly bullish right now. Morning, Busy Bee. Trying to get out at 8.28 on AMC. He wants to sell AMC at that price. If my holds this channel, I'd be grabbing those puts if it doesn't. Oh, got those puts. Stopped out of the call. Out of the last call. Let's see there. 828. Yeah, I think you could get 828. Thing is, if it's at 828, it very well could rip much higher. If I said it, you could scale there. Is that's 828 would be broken out of this wedge. You're breaking out to the upside. Given it broke out of the downside a little bit, so of course you can get a little false break, but thinking it's due for a pretty large bounce still. Like gap fill, teens, maybe even back up to 20. See if this is a cup and handle or if this was just double top. Really selling off here yet? We'll see. And 15. A lot of direction yet. You guys have done well though. 7 likes this morning so far. Look at that. 15 hour in. Here's a break on AMC, 4.8%. I'll look at some of these horizontal resistances. Just like here, it kind of broke to the downside, but then found support on that horizontal support. Could get the same stuff on the upside. SPY, hello VWAP.
You got the call, and then you got the two other sides to offset it. So $950 debit. It's not the cheapest
it's
trade.
No, it's not. But at the same time, it would be. I mean,
VWAP, I'm still holding these puts.
That 475 put
Could
is
close one at VWAP.
I forgot. I think it's trading around $9 or $10. So you're reducing what if you bought the call spread outright.
I could just chop it around for now.
Paying a lot more for that. So what I'm trying to do here is just finance the cost of some of the call spread, not the entire call spread, but also give a little bit of a cushion to the downside where you have the opportunity to get long at a better level, but you still get to participate for the most part to the upside.
Yeah, and you do get a pretty nice little bit of juice on there. So because the upside is the spread, it's not like totally exposed as if you were doing a Texas hedge, but it still is
a Texas hedge.
Darn bullish. So fun trade for us.
Yeah, or a buy ride as well, Al. Right. If you just bought the stock and sold
I've
the
heard of a Texas hedge.
Your break evens would be different than what this type of straight.
I like that Texas has a stock play named after them though.
Spot here. Nice. All right.
We'll see.
Cool trade. Thanks, Dan Deming.
All right,
a little upside here in Adobe. Shares up 2.5% this morning. When we come back, let's step away from some of the intraday action. Let's talk about mergers and acquisitions. We've had a
on AMC.
Notable deals the past few months, but according to data from the London Stock Exchange, there's more to it than meets the eye. We'll be right back.
$5.5. At AMC, wake up. Make my $10 calls back up. Got a printer to turn on. There's your first target, Busy Bee. 828. You got 825. Finger doing stuff. Yeah, fingers up 6.5. I don't like it. Just consolidating. Maybe a distribution phase. Below VWAP. Come on, let's fill that gap now, SPY. Make us wait all day. closed one of my puts. We're chopping around VWAP. Still have a runner. Also, it's still stuck in this range, just this horizontal channel even. So, might add more if we break to the downside.
Gee, let me think. Sure.
Busy Bee, thanks man, appreciate it. Thanks for the dono. Gee, let me think. Sure. I haven't heard that one in a while. Oh, that bounce on SPY. I think I'm gonna grab another put though. Liking this gap filly. It is pretty choppy though, but yeah, I just got back into another, but all right, let's see if the market will treat us well before we get into the chop hours. We get a MACD crossover on the 5-minute, bearish, red into the 9, run to VWAP. Might chop a bit, but I think we are going to continue to fill this gap. Also have to look at that longer term trend. Test on VWAP. Might wait to top of the channel to add more puts. Probably good on them for now. Palantir. A morning day trade there, nice. Oh, I guess, yeah, it is Friday. You're getting dailies. Dailies on everything. 300% though? That's insane. Yeah, Teladoc. Yeah, it broke through that support, was not good. Let's consolidate this in next support. We're back to 2017 pricing on it. So it holds here. If it drops from there, it's see like 15.5 on it. But the chart right now does not look good. No signs of reversal. Maybe some bounces here and there. We have a little RSI divergence there. The daily, if today holds up high enough on Teladoc, so maybe they'll bounce for a gap fill, but clearly in a downtrend. Busy Bee, I don't know if I would set it right at 850. I mean, I'm gonna catch it before the resistance. Got 837, 844, somewhere up here. Like I was saying, I mean, it breaks out to the upside with volume, which is what we have. It's looking good for a rally, so if I was gonna take some out, I would just slightly scale, I guess, at that point. Just a false break, liquidity grab for bulls. It looks like, at least. I'm gonna put some in this channel break. $37. 0 day for all. I know, I just trading SPY. I forget how you do it on all of them. But like on this position like AMC, if he doesn't want to hold it, like I get it. You just want to get out. So. Barbecue $13.69 at 9 cents. Off there, little breakout on AMC. 831 up almost 6 now. So weird how Blue Apron is just end up there. I mean, not even at the buyout price. Yeah. He's happy money. Good, good to hear. Got his 828. Well done. Hopefully it was a profitable trade.
Volatile stock for a kind of pseudo staple to some extent, but then, you know, kind of caught in some of this cultural crossfire to some extent. Seems like the analysts have maybe fully priced that in at this point when they start talking about potential for upside. It is responding to, not quite as powerful as Brinker, but it's up this morning, 3.5% almost, Rick.
A very similar situation, though. A break above a resistance level that halted right at one of our moving averages.
That's right at that
stopped right on the
spot.
money at our 21-day EMA, and we're
That
giving
did.
a little bit back, but we're still above that 55 mark, which represents our old lows from right here. Bigger picture, we had
I
an
got another one.
uptrend, and it wasn't super consistent or anything. It was, you know, kind of just, I just wanted to illustrate that we were making higher lows for a bit. We broke through that line here. Our moving averages are starting to fail a little bit. They're diverging farther apart. They're all kind of trending downward here. And the fact that they were clustered together so close speaks to weak trend anyway.
Fill
And you can
the
see
gap.
Mostly we were
Fill
between
the gap.
55 and 59. Green line and red line to the upside.
I think we're sitting to
We
849.
are not able to cross above that 21-day EMA today, though. That would be
What does that
an
make me if I'm
important
staying
sign
until
here for
25?
further upside. RSI improving a bit. We crossed
Or
out
40.
of oversold. That's a sign of a weakness
Idiot.
to cross into it. It's a bullish sign to cross out of it. We're still short of that 50 midline, though. Look for a cross above the 50 midline and a cross above our 21-day EMA.
going
for
the
kind
wrong
of a
way.
confirmatory bullish move here. Really,
SPY is
the
so
market
choppy
beat
this
is
morning.
59. These old highs right up here. Nothing's going to change until we break through the point where we saw that gap and this kind of price ceiling here. Downside, same thing, around 53. Lows and lows there. That's the mark to watch to the downside.
All right, so we got up off the lows here from the last 4 months and maybe trying to find a sideways direction instead of a downward one off the highs. Really depends on where you put the goalpost here. 1 year, good. Year to date, not so much. Month, a little bit less. And on the day, positive. So you can really pick whatever side you want for Bud, just like in the cultural crossfire. All right, thanks, Renita and Richard. When we come back, going to get an update on Bumble. Caroline's going to give us the latest on the dating app, which is finally catching a little bid here, up 5%.
SPY back up to VWAP there. Above VWAP now. Happy City. All right, I'm out of those butts. I guess it hasn't broken out of the range totally, but I should get another entry. We'll see. I'm at the place to exit. Definitely wasn't a place to exit. What was I doing? Still in the channel. Oh, I only exited one. Oh, actually I didn't exit, just stopped me out of that one. Okay, cool. I love it when my mistakes make me money. I was talking about adding once I was up here. With how I kind of broke that channel and then ripped back out of there, I don't know. It's not being very kind today. Good to hear, Busy Bee. Pretty hefty position. AMC stockholders are going to let the board have no liability. I don't know. Anything they can do about it? If we break this channel, then yeah, I'll close out these others. Just that stop I had on my other one, that one got triggered. And if we break here, I might get calls. Widen up this channel a little bit. Because it is so choppy. Give myself plenty of confirmation. But at the bottom of this wick, it tricked me on.
As a consumer, but these surveys are volatile because, you know, it's just
sentiment
a survey.
changes, yeah. But we have had market movement on this report before, which is why I bring it up.
On the preliminary report.
PCE hits at expectations, inflation expectations slightly above in the sentiment. So I guess maybe we could
back
call
down
it
to
kind
8
of like
cents,
a break-even
down
day
21.
as far as inflation data go?
Well, I think so. I think that's a good way to put it. I look, at the end of the day, just look at where the sentiment data is relative to the inflation data from an income and outlays or PCE standpoint. We're in the threes now. That's a good sign, I suggest. I think if you consider, you know, federal funds rate now relative to core inflation, we've got about 1% to 1.5%.
Yeah, up
Of
7%.
leeway there when it comes down to real
That is
rates,
neat.
and even if you consider 10-year rates, which are falling in the past few days, and I think that's providing a nice lift to the markets. We have a real, essentially a situation where you know, rates are still higher than core PCE at the 10-year level as well. So I think that's a good sign. I think right now the Fed is in a good position where they're at, and I think it's a situation where we can be patient and a wait-and-see attitude towards monetary restraint going forward.
Okay. One of the things we've talked about, Alex, that we've been watching is the yield curve widening out, seemingly a message of economic optimism these past 3 months. This morning, a little bit of the same continuation throughout this week, too.
Adding to my puts there.
That's worth noting here, because this doesn't have to be, for the record, the repeat of last year.
I don't like it around
Yields
VWAP.
going up for different reasons very have different effects on the market. I'm not sure if we know that yet. So far, the market's kind of generally just hated yields going up for any reason. But I think it should generally be in our framework that it's possible you could get stock strength as yields go up like they used to.
Yeah, we haven't seen that, and I think it's because I said this several times. What we actually have is the exact opposite right now, which is almost a perfect inverse correlation between yield and stock.
Right now, they're treating it like they did last year.
And I think it's interesting because if you go through kind of my lens that I'm looking at things is stocks have been on the soft landing, economy not so bad narrative all along. Bonds have been more pessimistic. I think both have been overzealous in their estimation. It's probably somewhere in between, and we're watching those two converge. So as the yield situation kind of has gone the way it is, that was maybe an underestimated aspect from the stock side. It was we want the cake and eat it too.
Probably a good entry for calls,
where
but I
the
might be
yield
whipsawed.
situation was certain the recession was going to be here, and it hasn't shown up. I mean, I'm still not so sure we're not going to get something. PMIs have flashed red for a long, long time, continue to do so. We're going to get ISMs next week that I think are going to be really important.
Yes.
But we haven't actually had it yet, and so until we're in that storm, it's hard to say how things are going to actually react, and at some point there's been capitulation.
What do you think, George? Bonds to stock connection, do we have to be like it was last year? Every time yield goes up, stocks go down? Does it have to be that way?
No, I don't think so. I mean, I think the aspects of the yield curve widening out right now are rather bullish for the equity market. I think it shows sign of strength in the economy, especially when you consider the Federal Reserve essentially cramming rates higher for the last year or so. I think it's been sort of a remarkable year, to say the least. I'm not really concerned too much about it right now, especially if the short end of the curve continues to stay where it's at. One of the concerns you have to be aware of, I'm sure you are, is if short-term rates start to fall. That's where the concerns really lie. That'll probably manifest when we actually see some weakening in the labor market, which we haven't seen so far as well. So I think productivity and labor are still intact. I think that's positive for GDP, and that's all you need to know from a variable standpoint to determine if we have economic growth. And I think it's still resuming to the upside. I just, at the end of the day, what I'm concerned about is maybe a policy error from the Fed. I think right now they're in a good position with the federal funds rate above inflation by 1 to 1.5%.
All right. And a good preview for us for next week, too. Those data points do become pretty important, the actual activity, to see if that's following along with the message of the yield curve of some revival. Thanks, Alex Coffey and George Tillis. That's it for me. Trading 360 with Nicole Petalides is up next.
Well, I was just going to get calls there.
Central Valley or NorCal, see you at the Market Drive tomorrow, the TD Market Drive in Santa Clara.
All those puts.
You know that stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Look at that flush now. Dang it. Dunk me both ways. Very glad I didn't whipsaw. Okay. Wait. AMC's coming down a little bit, below VWAP. Yeah. BB, you got a good exit. Or today, like this morning at least. If it retests the breakout, find support there, it'd be really nice. I need to wait for something real obvious. Spy, I don't want to get back in. Maybe it's obvious chop. It's actually interesting. We had the volume on the break of the up channel, and even more volume jumping back into it. Oh, seemingly bearish, but it's pretty ugly. Yeah, I don't know what's going on with this table. Okay. Oh, here I don't see. Kicker. Yeah, you had nothing. Maybe my kicker is bad. There's like 8 ways to a showdown.
There's that beautiful flush on SPY.
There it is. Filling the gap.
To make some decisions. That being said, can we talk about the high rate environment? Of course, we went from 3.5 to 4.5 on the 10-year. We're still up there pretty quickly. Yields came off a little bit yesterday, but the truth of the matter is we're still near these highs that we haven't seen in years. What are your thoughts on this higher for longer, and why does it matter to folks?
Yeah, I like the fact that you sort of piggyback those two, the Fed and the rates in the marketplace, because obviously this continues to sort of do that tightening for the Federal Reserve as we eventually, I think, see, we hope we'll see some further downward pressure on the headline inflation numbers despite this uptick in oil and gasoline. And so, essentially the real rate goes higher in this environment. And so that sort of takes some pressure off the Fed. Of course, the PCE numbers we saw today indicate that they are still a ways away from their 2% target. And I do think that the federal government shutdown, to bring it all back around, and Chairman Powell referenced this at the news conference, is yet another sort of straw, so to speak, that is among several that are sources of uncertainty and ultimately headwinds for the U.S. economy. Others, of course, are those high rates, a tighter lending environment, lower demand for loans. You're not going to have tremendous tremendous demand for loans when they're as costly as they are right now. So we've got plenty to work through here, Nicole, and I think these are reasons for caution. They're not, reasons for significant pessimism, but they are headwinds.
Tell me how people are doing when it comes to the credit cards. They have a very high credit card rate and defaults on loans and things like that. We have credit tightening. We've known that to be true. Even Jay Powell noted that to a credit crunch. So where are we standing as far as the consumer and how they are faring?
Yeah, I think, first of all, there's increased pressure on consumers. We see that in the University of Michigan Consumer Sentiment Survey out today, which really has been on the headline flat for 3 straight months. And consumers are not emboldened by federal government shutdowns, and certainly those who are directly affected are not helped by that. And they're also now having to weather the increase in gasoline prices. And we've seen the gasoline price situation being the highest for this time of year on record. So we're heading into a holiday shopping season. Indeed, our surveys indicate that people are already starting
our survey says
some of that purchasing. And I think it's going to be a constrained shopping season. And as we know, the retailers have had reason for caution as well. So it's not an environment that tremendously favors consumers here, but we can hope, at least perhaps even pray, that we'll get into the coming year and the Fed can start thinking about reducing rates. And that is the consensus among economists. And obviously we saw that on the summary of economic projections recently as well.
Yeah. And Jay Powell himself said, we were looking at that and was likely to be more likely to have 2 cuts rather than 4 cuts. I mean, we're looking at that for next year. How about gasoline prices? When we talk about an inflationary environment, and while some things seem to be behaving or going in the right direction, gasoline, not necessarily.
Gasoline.
Yeah, that's probably on top of economic factors that are sort of keeping me up at night, at least as the analogy goes, because yeah, this could really feed into broader inflation once again, Nicole. I mean, you have to transport so many things, including food, including the things that people want to buy over this holiday shopping season. And so the cost of fuel goes up once again. And so this could be sort of a black swan of sorts that ends up sort of, I don't want to say upsetting the apple cart for the Fed, but it's certainly not a welcome move in terms of where we are with
this pocket
inflation
pair.
and interest rates. And
why do they both keep re-raising?
We've seen situations in the past where high oil and gasoline prices
guys have crappy hands
by a time of economic constraint.
Probably don't have pocket aces.
This could be also another source of essentially stress for the U.S. economy.
Yeah. Good to see you, Mark. Thank you so much. Always. Mark Hamrick, Senior Economic Analyst, Bankrate.com. Thank you, Mark.
Probably have some aces, though. With
plenty more to come right
how
here.
low those cards are. Or some
Next,
faces, rather.
Three stocks, 3 charts, 3 trades. Rick
Put them all with pair sixes.
Through the technicals. Mike Shore takes us through the trades for onsemi, Affirm,
Pocket Kings.
Airbnb.
Oh, you actually had an ace. Look at you.
360 on Schwab Network.
Way too many people. Bouncing back up. Tilting. Hubs and all in. 8-3. Wow, you are definitely tilting. You almost got it too with the flush. Alright, I might leave this table. Just keep tilting. And 10 check. Alright, send an alert out to the Theta Farm members on YouTube. Close the trade today. All profit. Not waiting for the normal 50% on this one. Now all of a sudden everyone's scared, huh? Oh my gosh. I mean, I can't raise, right? I can just call. King 7, spades. Oh, spades almost got there. You. Here, take the calls on the break of this channel. Let the gap fill first, but yeah, there it is. There's the break. The VWAP also. I fold? Oh, good thing I folded. Or no, we would have chopped that, huh? It's like voting is fake. Imagine that. Little VWAP reject for that. It puts top of the channel. Good. I'm waiting for a better setup. Safe to say that this is actually up here. In a wider range. Nice breaking that also. There you go. A little retrace. Good though. A retrace. Okay, that's good enough for me. I got some calls. Good enough of a retrace. Risk reward isn't great here. Might just be coming to high today. So there's that. A lot of liquidity got built here for the bulls. But I thought they wanted more. I thought we'd looking for gap fill. Oh well. Back to going all in over here, huh? Gotta wait a little longer for the retrace. Never know. Etsy's up 3%. How did I fold that? Oh, I must have run out of time. Dang. I was scared anyways. Might be getting my second string account warmed up for this trade. Don't. Well, at least the channels are tapering, which is bullish. Wow. Managed to find more range for chop. Oh. Oh, yes. Look at that. Wow. Below VWAP now. Wow, this will give me a good chance to get some more. It's glorious. By buying it on the breakout is always the risk. Look at that liquidity. Holy dump a moly, look at that. Right back in it. See if we bounce on this higher channel now. Caught all the breakout traders. EU's closing in 1 minute. Or fee selling off. That's crazy. Dude. Oh, this is wild. Alright, let's see. Fill in the gap some more now. Grabbing a couple more calls there on the second string. It's just not a nice day so far. don't know how to chart this. Does look like it's rolling over though, the bullish side, even though it met with huge amounts of shorting. Unless if we break through that low, the R&D is starting to roll over, bullish. I was calling with a pair of 9s. Not a bad call, I guess. The original thesis of filling the gap, is that going to be true? Happy with it, but I don't know if we're going to get a bounce soon enough. Yeah, SPY's filling that gap. Dang it. Ugh. I don't know if we're going to get the bounce off the gap fill today on that handle. Flush made it. Flushed it. Frick. I had to. See, it's back under that resistance, isn't it? Ay, ay, ay. Behind your low there. They'll fill in this gap. And now another alert to Theta Farm members, another closing trade. Profit. That is neat. Joining my favorite tune. What's up, lords? How goes warring me, guys? What that means? Can't wait for Barbara to get wiped out? I mean, I guess I can wait. know why I'm calling that. That's why. Queen? Does it? Does it? Yeah, it's a queen. Oh, just straight out there too. Didn't even notice. Might come down a little more. You did have a straight. Always something else out there. I don't have a position in barbecue. Nope. Dang. Yeah, how about you? Holding something? dude. Got some GME. Don't be nosy. Just ask me. Ask you. Just doing today. Much. Was filled. It's a joke. It's not a joke if you still haven't answered. Still coming down for the gap. No, you were joking. It wasn't nosy. But it's not a joke since you never told me. You haven't told me if you're holding barbecue. So the joke about it being nosy is not a joke. There's the ace on the... Oh, it's queens. And the 6. What in the world? As for holding barbecue. Guess if I was holding any barbecue, and I said no. I said, are you holding any? Hello there on Spy. Did indeed fill the gap. Just the chop and sketchiness up here. Hasn't yet, actually. A bit further. There it comes. I need to figure out when to average into these ugly contracts. Or if at all today. Still have enough time. It's only 10 to 12, so good amount of time. Hush.
Thanks for being with me here today. Stocks are higher. Of course, we got in that PCE print, and the price pressures eased to at the slowest pace in 2 years. So we'll take it for today. Ending a quarter, it seems, a tough quarter.
That's your face?
On an up day. Thanks for being with me. I'll see you at 2 o'clock. I'm Nicole Petalides. Keep it right here. Fast Market is next.
Worse. Of course. Got fill? Yeah, got filled. It is completed. The task is done. Time for the afternoon trade. Prepare. You go long on SPY. I fill the gap. We did most likely this cup or this handle. Yeah, Joan is really gotten wrecked. No bounce today. Not looking good for Joan. Oh, $1. We're also down below that hourly trend line. So see if we wick out of here. Head and shoulders on AMC. Have a false break, maybe. Both ways now.
The weak economic data that we've seen there, not necessarily the case. And Nike CEO John Donahoe seemed pretty upbeat about China, saying sport is back in China. You can just feel it, and that gives us great confidence about the future and the Chinese consumer in our segment, regardless of the macroeconomic outlook there. So he feels good about their position there. And also on the earnings call, Nike said a highly promotional Chinese environment did not an improvement in full price
nice little
sales there,
shoulders
which I
down
think
here.
is
Break of
also
this channel.
notable. Meanwhile, sales
Show
in
of
North
support
America
here.
fell
But
2%,
we could shop around for a while. It's only
topped
noon.
Expectations. Inventories actually fell 10% to $8.7 billion. So that's a bright spot there. Nike said it's comfortable with inventory levels. And then gross margins fell about 0.1 percentage points to 44.2% due to higher product costs and currency exchange rates. But that was actually higher than analysts' expectations of 43.7%. Now, in terms of the outlook for the full year, Nike continues to expect revenue to grow in the mid-single digits. Analysts are currently expecting about 4% revenue growth, so in line there. Gross margins are expected to expand to 1.4 to 1.6 percentage points, according to Nike. So we are seeing shares higher, up about 6% right now. Only up about 4.6% on the week, though, which goes to show there was some weakness heading into this report. But maybe just a sigh of relief that inventories are improving, and that helps margins as well.
Hey, Caroline, one of the things that really caught my attention in that report is
there you go, SPY. Wow, coming in quicker than we thought.
Push those margin gains, 1.4 to 1.6% by the end of the year. How much of that is due to the direct-to-consumer push that Nike is really moving towards? And I guess the second part of that question is, how does that affect companies like Dick's and Foot Locker?
Well, we are seeing shares of Dick's and Foot Locker both higher today. Foot Locker up about 3% right now. Dick's up about 2%. We know that Nike's relationship with some of those wholesalers has definitely been rocky following this direct-to-consumer push. And Nike did say that member engagement with DTC profile is up double digits versus last year, and they expect it to continue to be really the strong point. So it's still very much a DTC push, but
completed your gap fill.
Clearly accessing customers via every channel, given
Got
that
plenty of
wholesale
time.
is up 1%. And they did
Break the
point
high
out
of the
that
day.
within wholesale, they see largely positive results
Do
from their
it.
what they call their most important strategic partners, specifically calling out high single-digit to low double-digit retail sales growth and strong inventory management with some of those partners, specifically mentioning Dick's as one of them.
Rocket.
With Foot Locker, it was interesting. On the earnings call, they said they continue to reset their business with Foot Locker, and they're still planning for near-term sales declines, given this kind of switch away as Nike's been switching more to direct-to-consumer. But they said ultimately we have a segmented portfolio of strong partners across price points and channels, with no single partner representing more than a mid-single digit of Nike's total business. Looking across the entire marketplace, we are confident in our brand momentum as we accelerate direct-to-consumer connections, elevate our brands, and create capacity for long-term growth. So Nike's still very much selling through all channels. It just obviously DTC is the most important one right now, but we aren't seeing any of that commentary weigh on shares of Nike, or I'm sorry, of Foot Locker or Dick's today. And even Under Armour, obviously a competitor, shares are up about 5% today, so could be rallying in sympathy with Nike.
Yeah, I wonder what this means for the consumer heading into the historically pretty strong fourth quarter here. Nike sales. China lagged a little bit, I guess, up 5%. So that's still a weakness for them.
My gosh, you had a full house. I had the higher full house.
But now let's bring in our next guest.
Way.
That's Alex Coffey, senior equities contributor here on the network.
That is so awful.
Alex, I wanted to get your take here on the market moves. Pretty weak September.
That is
S&P
so
500,
awful.
NASDAQ down 4%. It's been pretty broad-based.
I wasn't even looking at how that paired up. I could have full house.
Inverse correlation between yield and equities has returned, and really what I've described is seeing
out. Yeah, that's rough.
Throughout the year of 2023, we've had a generally optimistic equity market when it comes to economic prospects, and we've had a generally pessimistic bond market when it comes to economic prospects. And I think both have been a little bit over the target, and we're watching them come together here as we close out the year.
Come
so,
together.
Stocks, I think this has been the natural
now.
the direction that they should be heading, given the massive turn that we've seen to the upside in 2023, with nothing to back it up from an earnings standpoint, and no relentlessly
spiking rally enough to bring my trading
side,
account back
really
green today.
Had the recessionary
My B string
calls come to fruition as of yet, and so the bond market probably a little bit ahead of itself as well.
B string is almost back to break even. Could average down more.
That's a great segue for my chart that I've got to bring up here. It's basically comparing that 10-year yield and the rise that we've seen, the parabolic move to the upside, and coinciding with the S&P 500, if we can get that up. And I think, Joe, most of the weakness that we've seen from this chart in the S&P 500 has been since the Fed meeting, where they came out a little bit hawkish and took away some of those potential rate cuts for 2024. Give me your, I mean, we understand it. The equity market's historically optimistic here, but they had it wrong. We talked about it on the show multiple times. You see that divergence there, that 10-year has been rising pretty steadily, and now we're finally starting to get that weakness in the S&P 500, Joe.
Yeah, I mean, just take a look at the sectors that have been hit the hardest over the last month. Utilities, real estate, they're all interest rate sensitive sectors. You know, the only sector that's really had any strength at all is energy, and that's just kind of given off the higher oil prices. Looking at kind of what this sell-off has meant, the breadth collectively in the market is just really been punished. You know, we only have about 19% of the S&P 500 above its 50-day moving average, only about 24% of the NASDAQ above its 50-day moving average. But I don't know, guys, whether a washout is in play yet. I think that, you know, we're seeing a bit of a short-term bounce, but I'd like to see more members, you know, as crazy as it sounds, I'd actually like to see even more of those members get below those 50-day moving averages before I start to call for a washout. I just think that we're in a little bit of a corrective phase here, and we're in a bit of a kind of consolidation in a lower range.
Straight out there is a flush out there.
Until we see anything that resembles a catalyst from earnings.
Keep it light.
Joe, we talked about that chart earlier this week.
That Jack with a bad kicker.
Stocks that are below their 50-day moving average. It was down to like 13 or 14 just a couple days ago, so bouncing a little bit on the rally that we saw yesterday and the mixed markets today. But Alex, if you looked at some of the data today, personal income and outlays, there was nothing really that stuck out to me that was a little bit different. I guess that core month over month up 0.1 versus 0.2 expected, 3.9% year over year for the core. I mean, that's a positive, which is what the market wanted to see, right?
I think it delivers what we previewed, which was nothing. I think that they revised the prior number up slightly, and that was largely the reason why it comes in a little bit light. I don't see anything here that changes any trajectories anywhere. The Fed has been pretty adamant that they want to maybe do one more. The market doesn't have that yet, so I think what will drive us one way or another is either going to be market weakness, although, you know, allegedly that isn't something they're paying attention to, and of course what their words are. So we had Goolsbee kind of walk back some of that hawkish rhetoric this week. We had Kashkari do the same.
I need a 7 for that full house.
That's enough to buoy the market, because it hasn't been yet.
Yeah, Joe. It's almost like, you know, Fed Chair Powell comes out a little bit hawkish during his meeting. Then you get a couple of these doves on the Fed kind of appeasing the bulls here a little bit with their dovish commentary. But when you look at the S&P 500 and the levels that we've seen, down over 4% so far in September, I mean, do you see a bounce here, or is it going to be reliant on that bond market and the yields where they go for direction right now? Because that seems to be the case, that the bond market is leading the equity market.
Yeah, I mean, it's been the leader on the way down, and if, like I said, if you can get a little bit of abating of that sell-off, maybe some pressure coming off that move index, you might start to see a little bit of a bounce in equities. The hard part is right now, and Alex brought this up
Look
right at the beginning
at
of the conversation.
Shop at the bottom of the range.
There's nowhere to go, right? Both bonds and equities are selling off hand in hand, so that, you know, that inverse relationship is back. And could there be a secular change going forward as we're in for a higher for longer? Maybe it's a higher forever. I don't know.
Volatility down.
But I don't think the markets at this point right now are looking at
breaking
a real
through that
change
shoulder even.
in that
Ugly.
seat and where we're at in those bond rates. Now, I will say this: there has been a little bit of change in expectations for the next Fed meeting. I mean, you're looking at about 85% chance of a standing pat in November. So that's changed over the last couple of weeks, and part of that Davos conversation that you mentioned from the Fed governors was a catalyst for that.
Yeah, I think there was some bearish sentiment climbed to 40.9%. A survey done by the American Association of Individual Investors, highest since mid-May, Alex. So
I didn't get the
sentiment
flush.
has been bruised a little bit. Consumer confidence.
Oh, I did. I got a straight.
A little bit above expectations. I was
the flush and the straight were there.
With the
got lucky on that.
Oil,
river.
Inflationary pressures remaining, yields higher. I was pretty surprised to see that sentiment number come in above because consumer confidence on Tuesday was far below.
I'd leave this table.
Yeah, I don't mean to dismiss the
guy's
talking
leaving.
items here, Tom, but this is the
I've had
final
enough.
look. I'm more interested in the preliminary readings. That's the new info.
Right.
Essentially, we had a mostly done survey. Now we've gotten the full picture. So these incremental adjustments in the final versus preliminary to me aren't that interesting.
They're lagging a little bit too, right?
Kind of. I mean, it's sort of, there's some forward-looking aspects to it. They're asked about how they feel about now versus how they feel about in the future. And the consistent picture for the last 18 months has been now's a little bit better than, maybe the market expects it to be listed, so current conditions. But how do you feel about the future or the next 6 months going forward has consistently been worse. And so the ironic part is we've had a lot of those time periods pass where 6 months ago they were asked about now and they felt terrible about it, and then they feel okay about now. So it's just that constant living on edge, but it hasn't seemed to show up quite yet in spending. We'll see if it does in these last few months of the year.
Yeah, I think that's going to be key moving forward into the fourth quarter is going to be the consumer, how they can hold up. Actually, this weekend,
green,
loan
but
repayments start again.
Close to
Inflationary
turning red
pressures,
even.
crude oil above 91, 92 bucks a barrel. What that all means for the consumer, how much they're going to have to spend in the holiday shopping season. All right, let's take a quick break, guys. When we come back, we're going to take a look at Disney, the entertainment company stock, down about 17% over
Barbecue
the last
back to
12
8
months,
cents.
and a new, fresh 3.5-year low just on Wednesday. Fast Markets coming right back.
Fresh lows. Maybe a little double bottom there. I think I've averaged in enough though. Oh, choppy it's been today. I'm not sure we're gonna get a continuation to the upside. Excuse me. Oh, I thought I was putting them all in. Whoops. Have two pair. We got a second pair on the river. I mean, it's not like I was gonna win anyways, but Jack with a bad kicker, pretty aggressive. This guy's trying to bluff catch me every time. Doing it again? Check it down. He's not gonna fold. King Ace. He has nothing. Maybe we could have got him off that actually. Bluffed him off of that.
PE ratio in the last couple of years, sort of the Disney Plus era, let's call it, for Disney. We're down to 16.5 right now. So you don't even necessarily need earnings to be better than expected. If they just kind of come in as expected, you could make an argument that Disney, relative to its recent historical levels, is underpriced at these levels. And so I look at Disney, and I think Joe's point's the proper one, which is, look, they looked at this, made a very critical assessment of themselves, and realized, like, as cool as this streaming business and necessary as it is, it's not turning, it hasn't turned profitable largely yet for the firm. When you compare their legacy businesses in entertainment, they're not doing great. The bread and butter right now, and probably for the foreseeable future, is the parks and entertainment business. That was always the bread and butter for Disney. And so while maybe the pandemic forced them to look other ways while they had to, it's time to look back at what actually pays the bills at Disney. I think that's it's a good thing that they're doing that, but it doesn't go without expenses. I think that's the critical piece that you're referring to, which is recent spending plans. But you have to invest in those experiences. You can't take for granted your consumers. We've been talking about for several months now, Disney offering discounts and stuff in the holiday season. While some of that's just murmurs and rumor mill, that's concerning for a company that
historically doesn't do that.
Historically doesn't do that, but historically is a best-in-class experience. So if they're offering promotions, either they're losing out to competitors for dollars, or there is concerns for the consumer in the next few months.
Yeah, I think that's a big concern, especially with
oil
prices up
so
much, inflation sticky at this point. But you got an example trade for us here, Alex. Walk us through it.
Yeah, this is a strategy that oftentimes, say I was interested in becoming a shareholder in a name, I may consider deploying. It's also one that, again, is looking more at this stock critically, saying maybe it doesn't snap back. Maybe it just finds a base. Maybe it grinds sideways to slightly lower, and that can be good enough in a name that's essentially gone straight down for what seems like the last 2 years. I looked at a 1-by-2 put ratio where you're selling two out of the money puts, buying one just at the money or slightly out of the money put. In this case, it went to November 3rd. This is before earnings. I think the earnings date was the next week, or that was the kind of estimated calendar date for it. So going as far up in terms of good, but staying short of that earnings event to avoid some of that uncertainty. And given the volatility dynamics in Disney, it's not the most volatile of names when it comes to implied volatility. We couldn't get too fancy with sort of the gapping on this 1-by-2. It's pretty straightforward. Buying the 79, selling 2 of the 78s, looking for a dollar credit. So while this appeals to me maybe more so than just selling, like, let's say the 77 put for $1 and having the same break-even, if the stock grinds to the 78, this thing can actually expand to as much as a $200 profit. And if it does continue to go through, it does have that break-even down at 76. So you can stand to make a little bit more if the stock sort of grinds sideways than you would in just selling a cash-secured put, but you can still have that comparable lower break-even, higher probability of success that you may associate with a more out-of-the-money put.
Yeah, let's break this example trade down. November 3rd, weekly series, so about 35 days till expiration. Buying 1 of the 79 strike puts, selling 2 of the 78 strike puts. That back ratio, collecting a dollar credit. As Alex mentioned, the $76 break even. You got to be comfortable owning the shares because you got that extra short put in there on this one. Risk on it, about $7,600 if the stock were to somehow go to zero. Recent lows been just above $79 a share. Joe, give me your take here on this one. Above 79, you get to keep that dollar credit that you collected, but you do have that little kicker at around $78.
You know what else is right around that level? Your March 2020 lows.
Yeah.
So, I mean, look, we're in a different environment. I mean, the park's open, right? You can have visitors coming to the park, and it's basically at full capacity. We talked about 98% capacity on the cruise lines. And so what's hitting the stock is what we already talked about, the entertainment business. It's Disney Plus. So if you can basically buy the parks business at these levels, and Alex already mentioned the forward PE trading relative where it is to kind of historical norms. This gives you the opportunity to potentially buy a little bit lower here, a couple of maybe 4 or 5% lower than where we're currently trading, which, like I said, takes you back to those March 2020 lows in a completely different environment with the consumer that, even though it might be a little bit more strapped for cash than they are back when they were getting the government subsidies, at the same time they are still spending, they are still going and going to the Disney park. So a good trade if you're looking for something for a bounce, a good trade if you're looking for something for an entry at about a 5% lower level.
Yeah, wrap this one up for us here, Alex.
Yeah, I would say I
BBOP
look at
is so
this
low, though.
as sort of that blend between investment and trade. You're utilizing trade strategies, using complex option spreads, but you can utilize those to enter something you may consider a longer-term investment. Not to say that I would be interested in Disney one way or another, but Joe talked about this. You're going back to COVID spike lows at this level, essentially, with a break even below those. If you were comfortable acquiring shares in the stock, this is a way to trade it and have your risk be you simply buy a stock that you were already interested in.
Yep, definitely, because it's almost like a cash secured put with
Head and shoulders on Wayfair.
If it goes down there. But a good look at this back ratio example on Disney. And thanks to Alex Coffey, senior equities contributor here, joining us breaking down markets. But coming up after the break, Joe and I are going to be joined by Landon Swan from Lightfolio for a discussion on Apple and the data on the stock moves. The tech product maker has seen its stock shed about 8% so far in September, despite a new lineup of those iPhones. Stick around. We're coming right back.
Stick around.
AirPods as well. But I think the iPhone is the key. I mean, that makes up the bulk of their revenue. And so we really kind of focus in on that. They've got 4 different iPhones that they're releasing.
Stop looking at me, Schwan.
The 15, the Plus, the Pro, and the Max. And when you look at this time during the keynote versus last year, you can see it's very, very spiky, right? I mean, this is about as cyclical as a company gets for Likefolio because they release everything at that keynote. So you can see when the keynote was last year, you can see where it was this year. And we're up about 3% on a year-over-year basis. That's not huge. It's nothing to, buy calls or anything like that. I mean, we're not predicting that Apple's going to do extremely well, but it's good. I mean, we've had reports in the past where mentions were down like 30 or 40% on a year-over-year basis, and they ended up warning and selling off tremendously. So this is not going to be one of those years. If you're an if you're an Apple investor, I think you can rest easy that this is a decent year. It's not going to be bad. And they've got a lot of upgrades. They don't have anything amazing coming out. Like they're not wowing people maybe like Meta did, but they've got a good offering of products with the iPhone 15 ranging from $800 up to $1,200 basically. I think a lot of the upgrades come in the form of better camera, which is always going to wow people as sort of a viral way, right? You're going to show off your photos and yours look better than the person next to you because they've got an iPhone 12 or maybe they've got a Samsung, so that now they want to buy an iPhone 15. Now when we look at the happiness, you mentioned the overheating. There's reports of this phone getting up to 116 degrees, which sounds pretty hot to me. I don't think I'd want to hold that or have that in my pocket. We've actually haven't seen a big impact on happiness. So since the announcement, iPhone happiness has gone up about 4%. So it's gone up 4%. Now that people are starting to get them, we'll see. We're going to see if the overheating is really a big factor. Maybe there's just 1 or 2 phones. I mean, maybe, I have no idea. Maybe they left it out in the sun or whatever. We'll see. But as the masses start to report that they got their phones and they're starting to use it, that is something we're absolutely watching, that happiness score and claims of overheating, because the last thing that Apple would want is some kind of recall or something like that. So that would be a big problem, obviously. And then, you've got the watch coming out. They've got a new S9 chip that's 60% faster. It's got health data integrations with Siri. And, they've got the Ultra 2. I think that's up to $800 for that watch. And the basic is $400 now. So that's kind of what we're looking at right now. Overall, I'd say we're slightly positive on Apple here. We do like that, from an investor standpoint, I love that it's kind of pulled back a little bit. If you're talking about entry point, I mean, if you go back to the stock chart, it was from January till August, it was almost no down days. It was just up, 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 up. And then now we're kind of sold off a little bit, and now we're sideways. And we're down a little bit. So I think that expectations are likely lower, and I don't think they're going to have a bad consumer reaction to this keynote event. It's not going to be blockbuster, it's not going to be amazing, but not bad. It's better than last year. So I think investors at this price, I think they're in at a good value here.
All right, Landon, that all sounds good to me. And one of the things I'd follow up with is Dan Ives, WebPush analyst, basically said that demand for the Apple's iPhone 15 right now is outstripping the 14 by about 10 to 12%. Is that kind of what you're seeing from your mentions as well too?
We don't have that high. We've got a little bit lower. We're single digits. I think we're plus 3% on a year-over-year basis, but we're also very early on in the data. I mean, we're measuring from spike to spike. There's also the width of that spike as well, like not just the height of the spike, but the width. So the hype is still not died down. So we're still, we want to see how all of the area under the circle, if you will, to sort of use a math term, compares to that of last year, but height of the spike to height of the spike is about a 3% increase.
Yeah, and you talked about that. I just ran through iPhone 15 Pro Max. It delivers in 5 weeks. So the lead times are getting wider here, Landon. But when you look at this, batteries last a little bit longer. You don't have that hype as much as you did maybe 5 years ago when a new one, and there's lines outside of these doors. You can order it online and stuff like that. But you mentioned happiness.
I think
that's one of the things. Do you look at any of your data and say, oh, this person's never getting out of this Apple ecosystem because of the products and the innovation that they do?
Yeah, I think that's really important. I mean, it's a very, very sticky product set. I mean, just like you talked about, once you're in, all of a sudden the AirPods work easier if you have one, and the watch works better. Everything works well together, and then it works well with your friends and family. And then if someone with an Android joins your group chat, everybody's kind of like, oh, who's the green bubble, right? By the way, I used to be that guy. I changed over to iPhone a couple years ago, and now I notice it. I do think. It bothers me that they do that because I'm sure they can integrate with Samsung's data just as well, but it's intentional what they're doing, but whatever, that's fine. So yeah, it is a very sticky system. It's a very sticky ecosystem, excuse me. And once you're in, you're kind of in forever, but they don't have the hype of the newest, latest, greatest thing, right? I don't know when we're going to see that. I think it's probably going to have something to do with augmented reality, where you're holding up your phone and you can interact with things in a better way, sort of like what Meta displayed. And so I think when we get there might be some hype, but right now it's just, better, faster, a little bigger, better camera. It's kind of the same old, but it's still a very strong product. And so, I think the consumer base is going to be excited about it. And of course, there's always that conspiracy theory. Everybody's phone starts working a little bit slower right around the keynote. So maybe that's going to drive some upgrades. We'll see. But yeah, it's a very sticky product, and nobody's really leaving, and they're only pulling more of their friends and family in.
Yeah, Landon, stock down 8.5% so far this month, basically 4.5-month lows. You guys are just neutral on this one?
No, actually, you know what? I'd say we're leaning a little bit more bullish. So just overall, we like the keynote reaction. If this stock was trading at those August highs right now, I'd probably be a little bit more neutral. But I want to see it get back up to there before I would shift from bullish to neutral. So I think we're a little bit undervalued right now, oversold, if you will. And I do think that once these numbers start coming out, investors are going to be pleased. It's not going to be gangbusters, but it's going to be definitely not disappointing and a nice step forward for the company.
All right, great stuff, great data as always, Landon. Appreciate it.
Thanks, guys. Enjoy your weekend.
Yep, you too. That's Landon Swan, co-founder at Likefolio, breaking down the data for us on Apple. Joe, 3 straight quarters of declining revenues for this company. It's kind of put this stock on notice, I think, because going into that last earnings event, this stock was trading over $190, but it's almost like, hey, if you missed that run, because I remember a lot of people were bullish when that stock was trading 185, 190. Now you got it at a discount. How do you want to look at this from an example trade perspective?
I think you just laid it all out on the table right there, Tom. I think you and Landon did a great job. You don't even need me for this one, but I'm looking at this as taking advantage of that pullback, as both of you have mentioned. I mean, the stock pulled back this month. It was considered a safe haven, if you will, for the tech investing space. And, when that rolled over and the tech sector rolled over, Apple just was not immune anymore like people thought it might be. And I think it took it on the chin a little bit, maybe more than it needed to. I'm looking at doing an October 20th expiration, basically just buying a call vertical. The reason I'm doing that is because the bottom line is implied volatility is still relatively cheap, 29th percentile. You have the ability to buy an option that's slightly in the money or at the money, and then kind of pick up where you think your upside will be. So I'm looking at the 170, 180, so a $10 wide call vertical. Purchase that for about $4.20. The stock's been moving a little bit today, so that might have changed a tiny bit.
On GME.
I think what kind of hit the stock this month is kind of concerns over China and recent growth trends, and just central bank policy as a whole hit the tech sector. And Apple, like I said, wasn't immune to that. But if this is a stock that you're looking at as maybe a safe haven going forward, one thing to kind of consider is CFRA put this research together that says Apple's outperformed the S&P 500 index in 64% of market correction. So if you do think that the S&P has a little bit more room to head to the downside, might be kind of entering that corrective phase, maybe Apple's already had that, and it could be providing that little bump. Stock's still up 32% year to date, so it still had a good one. The major moving averages, it's below all of those except for the 200, which is at that about a 166 level, 166.23. It looked like, one of the things that I'm looking at in the chart, Tom, that I think is really important is there's a bit of a bullish divergence between the RSI and what the charts are doing. So as the chart's been going down, you've seen a little bit more momentum on the RSI, which is now trading 41, meaning that some of that selling selling
Guess I
might
could
be
have the
getting a bit
flash.
exhausted down at these levels.
Yeah, especially, I mean, you know, Apple's in 3 of the 4 major indices here, Joe. It's the biggest component in the S&P 500. It's the biggest component in the NASDAQ. I always look at this as one of those stocks is, if you think stocks are going up in general, watch Apple. If you overlay the S&P 500 with what Apple's doing, correlations historically been pretty high just due to its impact to that index. So let's break your example trade down here, Joe. October 20th, monthly cycle. So you got 21 days till expiration. He's buying the 170 call, slightly in the money, selling the 180, paying 420 debit. There's your risk, $420 per spread. Break even 174.20. The stock was trading above 173 earlier in the session before pulling back with the overall market. Your risk is that 420, as I mentioned. Risk reward, nearly 1-to-1, a little bit better than that. Now, going up to 180, that's only a $9 move. You got 3 weeks in this. If the market turns around, Apple gets some good metrics on maybe some sales. This could easily move forward, but good look at an example trade here. Joe, any final thoughts on playing directional? Because I look at strategies like this where if the market goes up or if Apple goes up, maybe hits 176, 177 before expiration, you have that ability, if the market's open, liquidity provided, that you can get out a portion of it or all of it if you want early.
Yeah, I think it makes a lot of
GME's
sense.
price action has been really weird the last couple days.
You can peel a couple of them off. You can roll it out if you want. The reason I chose
Very
the October
strange,
20th
just this,
keeps
like,
you out of the earnings cycle if you
tight
don't want
range.
to be involved in that kind of binary event.
Super low volume.
But once again, when you have a
Yesterday
vertical
was actually
spread
higher
like
volume,
this,
but
it
look
gives
at
you
this,
the
just really weird
flexibility to
price
make some
action.
adjustments along the way should you feel
Like an
feel the
algo
need
for
to.
sure.
And if this thing is working out for you a little quicker than you expected, there's no reason that you can't take it off.
Right, good stuff on
AMC
that.
popping up above you out there.
Example trade there in Apple. If you think this thing's going to
Here
rebound
we go.
over the next 3 months, this type of strategy takes advantage of that. All right, let's take a quick break
Pretty
here,
bullish
Joe.
to
When we come
break
back, we're going to take
the
a look at
upside out of a
Netflix.
Head and Shoulders.
The streaming stock has pulled back about 13% so far in September. It is near support at its 200-day SMA. That's simple moving average. Fast markets coming right back.
Coming down a little bit here. zone there, so looking pretty bullish.
Netflix been doing over the past, let's call it a decade or so, they've been moving to create their own content. Now, that content strategy business has worked out for them for the most part over the past 5 to 6 years, but I think they're going to be facing some content drought problems going forward. And I think at the end of the day, they're trying to offset some of that based upon the improving revenue trends that they're seeing from advertising. I think at the end of the day also, if you consider what's going on from an earnings and sales growth, last quarter, when they reported back in July, sales were down below, in terms of growth, below 3%, but so were earnings. Now, on a forward basis, they are expecting earnings to improve to the low double digits, around 12.5% on sales,
coming down there.
7.5%. The company itself is doing very well. If you just look at net income, it's about 13% of sales, as well as the fact that they're generating double digits in free operating cash flow. So they're improving their content creation. It's costly, but at the same time, their cash flow is also improving to help offset the cost of that. So I think right now Netflix, if you look at it, it's trading right around its 200-day moving average. I think from a trading standpoint, it looks rather enticing. But I think from a valuation standpoint, I'm going to call it relatively balanced at this moment.
George, I want to read a quote that came from the CFO. He said, "Not prudent to keep growing at 3 percentage points margin per year." I think the street thought it would be prudent for them to continue to grow at 3 percentage points of margin per year. Basically what he's saying is, look, we're not going to be able to cut costs to the extent that you want us to cut costs in order to continue to have a growth opportunity.
Too low there on
SPY. That's kind of led to the sell-off that we've seen in the stock?
Yeah, I think so. I think at the end of the day, if you look at even what's happened with the writer's strike, just for example, I think it creates opportunities, especially when there's a lot of time to sort of digest what's going on, for them to go through their company and look for ways to cut expenses. And I think at the end of the day, Netflix really can't, from the standpoint of making it meaningful, because of the fact that they have such a huge expense for content creation. Now, that's certainly being offset from the additional revenues they're generating from advertising. But I think right now we're sort of at an inflection point, and I agree with them. I don't necessarily see margin capabilities to improve, especially when expenses are going to increase probably at the same clip that they have in the past. I think they're going to be generating more sales growth. But at the end of the day, you also have to consider, growth relative to valuations. And looking forward, now next quarter looks like it's going to improve significantly compared to last quarter, 12.5%. But if you look at the next 4 quarters, their EBITDA growth is expected around 10%, with sales right around 10%. So that relatively is balanced. But if you look at their forward multiple, 31 times this year's earnings, but 24 times next year earnings, it's basically trading at 2.5 times EBITDA growth. So one would say maybe it's a little bit overvalued, but others would say, hey, that you could add a little bit of a discount factor to that, and to the point where maybe it's still undervalued, let's say between $30 to $50.
Yeah, Joe, and that CFO in mid-September, he made some comments at a B of A conference, and one of the things he said was that the ad tier, not material yet, and operating margins continue to struggle a little bit. Is this just more of like a time frame type of scenario? Because I don't think they're going to lose a lot of subscribers, but at the same time, ramping up that ad tier has been slower than what they wanted, almost a walk instead of a run, according to CFO.
Well, I mean, in my opinion, it's something that they got to get figured out in 2024. George hit the nail on the head. We talked about, cash flow is really what is going to be valuing the stock going forward, and they've done a great job with securing and increasing that cash flow. But until they're able to really kind of monetize that advertising revenue to a point that becomes more and more substantial, you're going to have that intersection between the cost of content and that ad revenue generation, and it's only a matter of time, before we kind of see that become realized, and the hope is that happens in the first half of 2024.
Yeah, that's a great aspect to look at. And all right, George, appreciate it. Have a great weekend, George. That's George Tillis joining us.
Thanks, guys. You too.
Yep, thanks. Senior markets correspondent here, breaking down Netflix. Joe, so I looked at this one. George mentioned that 200-day moving average is just below 370 a share. It hasn't been below that level for about 11 months, Joe. So I looked at it that way, that 13% sell-off that we've seen so far. But I still want to remain cautious on this one. They report earnings on the 18th of October, Joe. So implied volatility in that October 20th monthly cycle that expires in 21 days, pretty elevated at this point. So I looked at just selling an out-of-the-money put vertical here. It's neutral to bullish, but it gives me some cushion to the downside in case we do start slipping. Selling the 360 strike put, buying the 350 strike put, $10 wide, collecting roughly about a $3
Plowing from green to red.
Takes your break even on this one down to 3.7, Joe. Give me your take on this short neutral to bullish put vertical here, Netflix. A little bit of caution.
Yeah, no, and I think the caution's warranted. I mean, look, if you look at the expected move of the stock within that time frame, you're looking somewhere around $30 to $35 in terms of what it could do.
New low there on SPY, still flushing.
And more than likely, that current implied volatility is going to expand as we get even closer and closer to that earnings event. So that, those straddles are going to hold their value, and that's traditionally the case as you get closer to earnings. I think you got a couple things that are setting up for you on this trade. The fact that you do have some technical support around that 200-day moving average. The fact that the stock has sold off dramatically from its near $500 high, and the fact that you got about a $20 cushion before this thing hits its break even. So when you're looking at this trade, yep, it's a bullish to kind of slightly neutral trade, but at the same time, it is risk defined. So in case you're wrong, you have the ability to play another day.
Yeah, we got risk of about $700 on that spread. The difference, the $10 minus the $3 credit that you collected
GNS
on
getting
it.
sold off, down
probability
15.
of that break even around that 357 level is about 65%. So you've got better probabilities in this type of trade. You do have some assignment risk on that short option on the 360 put going into expiration over the next 3 weeks on this one. But a good look, taking advantage of that higher implied volatility in the earnings month. Now, a lot of times we'll talk about, hey, let's avoid that earnings event. This one takes advantage of the higher implied volatility where you're going to collect more option premium on that. But you've got to be comfortable that the stock's going to remain above that break even at 357 over the next 21 days. Joe, I wanted to get your take here as we wrap up that example trade in Netflix. Just your outlook for next week. I think earnings basically done. We've got another week and a half, 2 weeks until the financials start leading us off there. What are you focused on next week as far as data goes?
Are we going to get data, Tom? I don't know.
Yeah, that's true.
That's a big goal, right? I mean, look, we got CPI, PPI coming out in the upcoming weeks. Next week the real number is the jobs report. But after that, if we don't have the ability to collect data, and you got a data-dependent Fed, there could be some issues around that, and the market's going to be trading around that. Hopefully, this issue that we're dealing with over the weekend with the government shutdown is not a long-term thing. But I think it's something that does need to be at the forefront of investors' minds. Now, in the past, historically, right, when we've had these shutdowns, markets have actually done fairly well. If you can look at it that way, they actually have. I think in about 80% of the cases, the markets were up during that time. But at the same time, it does add another layer of complexity and volatility to this market that's already felt a little shaken out. So we'll see what happens.
Yeah, the jobs data, non-farm payrolls on Friday. You get JOLTS report earlier in the week, ISM manufacturing and services data next week also. But I think it's all going to be about jobs. And don't forget, keep an eye on the automakers also as that strike continues to extend at this point. All right, Joe, great stuff as always. Appreciate it. Have a good weekend. Yep, that's Joe Mazzola. He's Director of Trading and Education at Charles Schwab. That's going to do it for us here on Fast Market. Stick around, though. Next Gen Investing is coming up.
Next Gen I.
Positive. There isn't one. This was a really nice update that has completely faded. The only thing that could save it would be a rally in the next 3 hours before the closing bell, Jenny, but this is just the reality of what the market is right now. It is rallies that are failing, and on the days where we start lower, we're going a lot lower. So the market's got to figure something out here quick, or next week could be interesting.
I completely agree, and I would say that after this week and the fourth losing week, investors and bulls are sort of starting to lose some patience here. But we do have a ton to get through today. Some news catalysts to break down. As always, we'll be kicking things off here. We'll have a downvote segment following that.
I think this is the end of the month.
Upvotes, our FOMO
We're getting some rebalancing.
Is all things Nike, as we are seeing
I have an
nice
explosive end today.
Perhaps some better than feared earnings, and then we will be really breaking down all things Ford.
Which way
we did get some
it's exploding.
UAW updates. Workers not very happy. We did hear from President Shawn Fain, so we'll discuss more about the latest with one of the Detroit 3 auto companies later on.
A lot of what we talked about with Nike seems to have come to fruition. Hard to spin the report as an overly positive one. It wasn't bad, of course, but the stock higher. Much like we talked about, that pessimism leading in, really lowering the bar, set the stage for outperformance to the upside. So I'm looking forward to FOMO, no doubt. And it's lunchtime, at least here in the central time zone. Late lunch maybe on the East Coast, not quite there on the West Coast. But let's talk some restaurant brands all over the board here for upvote, downvote, not endorsements, not recommendations. But we got names from Brinker to Texas Roadhouse setting the stage here.
We do. So we'll start things off with Brinker, as this is the company that is, behind several brands. This is actually one of the largest of the group. I broke them down by size, as Restaurant Brands is largest, but we'll get into that one later on. But it does seem like we are seeing some optimism from this company. We are getting a nice 3.5% move to the upside today. And Stifel upgrading shares to buy from hold, raising their price target to $45 from $38. And it does seem like what they said is this is a company that is seeing progress primarily driven by Chili's turnaround efforts. They did say that after years of following a top-down decision-making process, the company's team members are now being encouraged to cultivate a more growth mindset that's under the new leadership of their CEO, Kevin Hochman. The analyst also said their international turnaround plan for Chili's does mirror the strategic playbook of successful restaurants like Olive Garden, Popeyes, and KFC's. Chili's greatest challenges, they said, right now are currently operationals, with several opportunities to implement some of these changes in the next few quarters, which should overall improve investor sentiment here. So some positivity definitely linked to all things Chili's. They do also have several other brands under their umbrella. I tend to think of these almost as like airport brands, because they also have Macaroni Grill, which is like an O'Hare staple.
Yeah, I avoid O'Hare like the plague. I'm a Midway kind of guy myself, Southwest Airlines with the shout out. But Brinker, not as good as the stock ticker. EAT is what I'm going to refer to this one as. That is a great stock ticker. Not a fan of Chili's either, but the analyst likes it. Upvote to, or upgrade to buy from hold. Price target of 45, as you said, up from 38. A lot of optimism here, but not necessarily a lot of these kind of names that we get deep into the weeds to, so I am excited to explore this one further. No weekly options, so on the trading front, as you'll see, it gets a little bit more sparse, but it's a fun combo, especially on a Friday.
It is, and so we'll continue with our food and restaurant theme. Our next name today is Texas Roadhouse. Now, Texas Roadhouse is considerably smaller than some of these other players, just given the fact that it does have 600 restaurants in the United States, although 11%, go figure, are found in Texas. And I also, fun fact, outside of the analyst note we got today, is that they produce on average 5,000 to 10,000 rolls per day at each given restaurant, because their rolls are like one of the best parts about eating at a Texas Roadhouse.
Cinnamon butter.
Yeah, exactly. So that is a good fact. But we did see North Coast upgrading shares to buy from neutral, $118 price target. This does put it actually at the lower range of price targets we see, ranging from $103 to $155 among analysts. Average rating is outperform, but this name is also seeing, some strength today, up around 1.4%. Texas Roadhouse typically isn't one to move the needle very significantly. It has a massive footprint in more of the non-urban areas. Suburban areas is what I tend to think of when I think of Texas Roadhouse. But a fun one to revisit, and 5,000 to 10,000 rolls, that's a lot of rolls.
Yeah, and see, this is where like you growing up in Chicagoland sticks out. The urban, suburban. I talk like that now, but like where I grew up in Omaha, it's like only suburban. So Texas Roadhouse is a staple in Omaha, Nebraska. It was great. I remember going to this place from time to time. Wouldn't have never guessed that it was a publicly traded company, but pretty nice market capitalization, $6.5 billion on it. Be an interesting one to watch. TXRH. So once you've seen it, you'll never forget that. Texas Roadhouse, TXRH. Next one, quick service restaurants, or better known as restaurant brands. Parent company of BK.
Parent company of BK, so this one is the largest with all of its various brands, those being also Popeyes.
5,000 to 10,000 rolls.
Their primary driver, but they have over 30,000 locations around the world, though.
What
so
they said.
That is something to consider. Much
I was
the
listening
biggest
either, I guess.
company we're looking at in terms of store footprint by a lot. But Loop Capital today upgrading this company, and a lot of it was attributed
Never
to
seen that ticker.
the strength that they're seeing,
Texas Roadhouse.
particularly in Burger King. And I will say, so upgrading to buy from hold, we did also see this name does actually see some love among analysts. Price target was raised to $81 a share from $77, so that does imply some upside. But Street likes this name. Average price targets range from $70 to $90 a share. Has an average rating of also outperformed, so Street does still feel relatively strong about this.
Jeez, SPY's still selling, man.
Key things about Burger King's turnaround plan. They have these wraps that are adding
Or if it
actually
has to do with the end of the month.
value to their top and bottom line here. They have done really well since rolling out. They also said their Whopper campaign has done extremely well, sort of revisiting in consumers' minds that the Whopper is something that's unique to Burger King only. So that's also been very successful. And I will say that from a marketing standpoint, their song gets so stuck in your head, but I kind of love it. So they've done a good job rebranding and sort of, I'd say, reigniting some interest in consumers' minds, which is what this analyst highlighted.
Nothing worse than watching your college football team give up a touchdown, go to commercial, and the BK song comes on. But, you know, that's maybe just PTSD for me, though, because I have a theory. You either grew up a McDonald's family or you grew up a BK family. I don't know if I can forgive my parents for making our household a BK family growing up, but I've since changed to McDonald's. But all jokes aside, Tim Hortons is as much the importance to this company. Firehouse Subs, you saw in the B-roll, excellent quick service restaurant. This is a fun company. BK, what a turnaround, just solely the song. I don't know if I'll ever step in one again, but the song alone, I'll never forget about BK.
See, and sometimes if your team is doing well, then followed by the BK song, it kind of amps you up, I think. It really depends on how the game is going, but I agree.
My team's never scoring.
Yeah, well, that is, if I watch my college team, they would also be never scoring. But our last name today is somewhat different. That is Anheuser-Busch, which of course has had its own fair share of difficulties this year. It's down around over 7% now on the year. However, we are seeing an analyst that feels more optimistic on this name, saying that the company's margins appear to be at an inflection point, given that the cost of goods sold has started to decline. That's per B of A. They upgraded shares from neutral to buy, raising their price target to around $68.74, and that's in terms of US dollars, from around $62, saying that last week at the Mexico Capital Markets Day, they highlighted the business transformation in several key markets, particularly in Latin America, with a clear portfolio strategy and digital to its route to market, they said. The transformation and increased competition in several markets has resulted in better volume and sales growth in the past few years. Until now, they said this was not converting into healthy organic profit growth due to some of their external cost pressures and the higher cost of doing business. However, they did say that with the portfolio transformation well advanced in many markets and starting to attract some third-party margin accretion in their various partnerships, they believe that Anheuser-Busch is in a well position to capitalize on some of these strong markets, again, particularly in Latin America, to capitalize on its growth going forward. This name has seen obviously a great pullback in their Bud Light sales. I just roll my eyes at that whole thing. Drink whatever beer you want, whatever. But what we do know is they have so many other brands. So actually their most recent earnings quarter showed that they have strength even outside of Bud Light. Obviously that's been a major hit as far as like PR goes. But I guarantee in a few years we could see that evolve. What I do know is it's led to strength in other brands, like Modelo, for example, which is owned by Constellation, has seen, now it's considered the best-selling beer in the United States. They've seen other leaders emerge, but this company is so much bigger than just Bud Light.
This seems like a situation, though, Jenny, and I'm with you. I roll at some of the stuff, but this is a routine type of, like, we think of Starbucks, something you get on your way to work. You're maybe loyal to that brand, whatever it may be. When you get in the groove and you got your beer or beverage of choice, and once you've broken that mold, who's to say it'll go back? So some of these customers that they've lost for whatever reasons may never go back to being Bud Light drinkers. as one of the most successful products in the history of the world, it's got some looking in the mirror to do and figuring out how it's going to win back some of that audience.
Yeah, I mean, definitely, I think this will be a years-long story, that reshaping and regaining those lost customers. But again, yeah, I'm sure there are some that will never drink Bud Light again, to which I say, shame on you, I guess. But we'll be diving more into our up names, those being the largest players in the restaurant space. We'll avoid beer, I guess, for this Friday, go into more of the food-focused companies. E as well as QSR will be looking at the technicals as well as some example trades of both those names. Stick around, Next Gen Investing. We'll be right back. Here to tell us more on these two names, I'd like to welcome in our chart master, as always, Rick Ducat. So Rick, we'll start things off here with Brinker, as we are seeing some weakness as of late, and then a move up. I mean, this is one of those charts where it's like, where are we even looking?
Yeah, this one, it's a bit all over the map here, but the broader shape is a triangle, like a triangular shape here with one trend line going across the lows, one going across the highs, starting with those yearly highs near 42.12. We had a notable downside excursion here, though, and this was significant, I thought, because it stopped roughly around the same point as our old lows right here near about 32.62. We did cross a little bit below that point, but we rose up significantly. We fought our way back into that triangle shape. For a while, it was looking like we might cross over to the upside, but everything kind of collapsed. We had an earnings event that took us downward and formed a new pattern here, which is our downward sloping channel. Today was looking pretty interesting because we broke out to the upside. We stopped short at our orange 63-day exponential moving average right on the money. An illustration
new
of
low
why
there.
it's good to be aware of these moving averages. They are support and resistance, spots that many traders follow. So as you can see, we stopped right on the money there. We're falling back below that 32.62 level that I highlighted earlier. We are still above our trend line and our 21-day EMA, which are in confluence. They're right on top of each other. So that's a point to watch to the downside here today. Overall, though, Moving averages mostly trending down. The 21-day EMA just starting to barely tick upward here, so that could be something worth watching if we get some more follow-through after this gap upward. That could be a sign of early trend change here. But our medium term and our long term
Notice the VWAP didn't really come down much with this drop at all.
EMAs, they're still trending
The
downward
low volume
here. So overall,
drop.
the prevailing trend
We still could get that afternoon
down.
rip.
We still haven't crossed above.
I don't think it'll be new highs necessarily, but
well near 35. So a nice
maybe
move
back to
upward
VWAP
today, but one that's faded notably since the open, and still overall looking like a downtrend.
Right, and even though we're off of our lows by about, 34.5%, it's been definitely a story of looking at things to the downside. I feel like that's the theme of the overall market, but as far as momentum goes, what are you watching here?
It's a bit of a rougher time, the broader market's turning around today too. Maybe that has something to do with our weakness that we've seen since the open. But I thought momentum was actually pretty interesting because you can see here we had repeated
barbecue
crossovers into that
7
oversold
cents.
area, kind of rapid fire back and forth, kind of this odd, upside down M shape almost here, trending upward though since we hit those lows. A little
GNS
bit of
sold off
bullish
today also.
divergence here as price trended downward.
folded.
RSI was trending upward and making a higher low. So that can be
to
a
not
sign
fold.
of some steam building up in the name, the sign of an impending bullish move here. Sure enough, we did get that move. We are crossing above the 50 midline as well today. So we're having a breakout above resistance, and RSI, our measure of momentum, is crossing into the bullish side of the camp here. So that's a good sign for the bulls. We'd really want to see some follow through though, some additional price movement to the upside beyond this resistance level that we've highlighted here for it to really be a more compelling move that would seem to have more staying power. But right now, momentum is actually favoring the bulls, I would say.
So momentum favoring the bulls, that's one bright spot to obviously consider here. What about support and resistance to keep on our radar?
Well, like I said, 32.62. That's that red dashed line there that matches up with the old lows that we bottomed out near that point twice. If you're looking for using trend lines and support and resistance levels, if you're expecting it to stop on a dime every time, you're probably going to be disappointed. There's a little bit of give, a little bit of leeway with these areas here. So if something stops around the same point, it's worth noting. So we have that 32.62 area that we've fallen through once again today. So this is still a resistance point to watch. If we were to continue to the upside, we've got our 63-day EMA right here that we stopped at this morning. That would be a point to watch to the upside, and really the 35 level right around here, this pink dashed line, that's the point that we'd really want to
average into
cross
those calls
and eventually fill the gap that formed right there near 36. So those are the real key points to beat to the upside. Those would be a sign that the trend is really shifting from downward to upward. To the downside, our support confluence that I mentioned right there near about 31.50. That's our 21-day EMA in concert with our old trend line here. Old trend lines are still worth following because they can still be supportive even if they were breached like this in this case. So that's a mark to watch to the downside.
Yeah, and I think that obviously near-term downtrend, but all in all, this name, we are seeing some bullish momentum as far as RSI goes, so I'll take that and run with it here. So Alex, when looking at trading this name, leaning into some more bullish activity perhaps, these restaurant names have proven to be somewhat more stable, and we are starting to see food prices at least moderate on a year-over-year basis.
You're low there on SPY.
You're just handcuffed by the strike availability, the expirations available, when earnings may be, the stock price, and in many ways, in this particular case, sort of all of the above. There's not a lot of selection when it comes to options and not a ton of premium in them. And so we're looking at buying a call vertical, a strategy that's set up, still meeting many of our kind of loose guidelines for it. That is a bullish strategy given the availability of strikes. So we went out to the October monthly. That's the only expiration that would be pre the next earnings event. And then we looked at buying one strike in the money and selling a strike that's out of the money. So buying the 30, selling the 35, and looking for about half the width of the strike, so 250 for the debit. That brings our break even in this case, add that 250 to 30 to 32.50 on it. Or we got QSR here on here. So what we're looking at on this particular one is the other risk profile for the other chart, but same exact style trade. So when we get it pulled up on the right one, we'll look at it. But 32.50 break even. risk 250 to make 250, Jenny, on this. Exact same trade as you can see we're about to look at in the next one, but we'll get to that in just a second.
So we'll look at QSR here from a technical standpoint. QSR making a modest move to the upside today, up around 0.3%. Another name actually eerily similar is also off its lows by 30%, but seeing again a significant pullback alongside the overall market.
And a very similar situation here regarding our gap up that stopped at a key resistance level. We've got our confluence of the 21 and 250 two-day exponential moving averages, which also line up with the resistance area in the 68 mark that I wanted to highlight here, because this is a point where price topped out numerous times. Several times around there. So as I said, if you're expecting to stop right on the mark at 68, you're probably going to be in for a disappointment. It's, a little bit of a more fuzzy boundary here with these support and resistance lines, but you can see 68 was an important price level. Now I'm finding the chart is at a bit of a crossroads here, because we have this longer term uptrend, our blue dashed line. It's been broken. It's been broken to the downside. We retested it. It became resistance, kind of traveling sideways from that point. Once we hit the yearly highs too, we also formed a downward channel, a rather narrow shape encompassing our price action here. We've also broken to the side beyond that. Not really a big breakout in either direction though, as it kind of drifting listlessly between the boundaries of roughly 65 here, this green dashed line. That's about where we formed this gap here that we also filled. So now we've got an extra layer of supportive evidence for the 65.26 level, and also to the highs near 70 here. So, kind of just bouncing around, looking a little more sideways here. Our short-term and medium-term moving averages are trending downward. Our long-term one is trending to the side, but they're starting to overtake each other. Our faster one is starting to cross below. Our slower one, not a good sign for trend overall, despite the move upward today.
So now as far as momentum goes with this name, are we seeing, similar price activity and momentum, or, okay, I can see clearly a green arrow that signals some upside.
Yeah, kind of a curious situation here, because we had, once again, moves into the oversold area, which are a sign of weakness and a sign of typically bearishness here. And you can see that price was also trending lower at the same time. However, we also were making higher lows in the RSI. We've also got a bit of a trend line here, a line that goes across these lows trending upward. Trend lines can work on the RSI similar to price. What we would really want to be looking for now would be one of two things. If we keep moving to the upside, we'd want to move beyond that 50 level and a move beyond resistance at the same time. So price to break out and RSI to cross from bearish to bullish. On the other hand, we could also, if we're more interested in the downside, be looking for a break below our RSI trend line. That could be a sign that momentum is starting to fall apart. Especially, it would be even more convincing if we were to break below support at the same time. So kind of one of two scenarios to be on the lookout for that could help us form an outlook about this trade. But right now, it's trending to the upside. We're seeing bullish divergence. Usually that's regarded as more of a sign of strength, especially considering that price is kind of downward to sideways, not really making a big move overall.
So now, as far as key price levels to keep on our radar here, these charts actually look eerily similar to one another, but what are you keeping on your radar?
They do look a bit similar, yeah. And I think that, the levels that I mentioned earlier, those are the kind of the key things to watch here. We've got this green dashed line right around the 65 mark, right around here, and here we had our gap up begin and our bottoming out action right there happening yesterday and the day before. So 65, just above that level, is where many traders likely will have their eyes on to the downside. We're at another supportive point here today. This big, thick red line here, our volume profile point of control, the area of heaviest trading during the given time period. This is commonly looked to for support or resistance. That's about where we are today. We're just less than 10 cents below it. So this is a key area to watch heading into the close. To the upside, right around here, that confluence that I mentioned earlier near the 68 mark, our two moving averages coming together and our old highs in price, that's a mark to beat. Also 70, that's our relative highs beyond that point. That's about where we topped out during our last upward swing. So 65 to the downside, 70 to the upside. Pretty straightforward on this one.
Yeah, pretty straightforward. And this name's still making a 23% move to the upside on the year, despite this recent pullback. We will leave it there. Great breakdown on both of these restaurant names. Rick Ducat, our chart master, as always. So, Alex, now we'll revisit QSR as far as trading goes. And I know you mentioned something that's important with these names, and it's the lack of strike availability. Price is sort of not limiting you, but definitely influencing an example trade when looking at both of these names.
It just takes some strategies out of play if you're trying to do them kind of in line with some of the loose guidelines that we talked about. But deja vu, we're looking at a call vertical in a name with $2.5 wide strike availability, limited option premium, and only monthly expirations on the board. And so looking at QSR, 65.70 in this case, 67.5 is the break even, as you see there. Risk 250 to make 250. The making is all above 70, so you need an upside rally in this stock. All the risks to the downside below 65. This is the bullish look at it, and as you and Rick talked about, these charts look a lot alike. The stocks are in a lot of the same type of business. One a little bit more quick service than let's call the Chili's parent and Brinker, but still operating in restaurants. A lot of the same factors from a price, cost standpoint is all going to influence it. So a lot of the same type of trades will kind of emerge as potential candidates and illustrations at the same time. And so that's what we're looking at here. QSR, October call vertical, buying this thing with a break even near the current share price, check mark number 1, and equal risk to reward, check mark number 2 for the debit spread.
So I'm curious about both of these names with the strategy selection somewhat narrowed, like we've discussed. Does that impact the liquidity at all? Or are these sort of like the chicken and egg? Like what exactly then does trading both of these names look like?
Yeah, it's a good question, and it is sort of a chicken the egg conversation, because if there was more trading interest, it may lead to more strike availability, and it certainly may lead to more expirations being on the board. So oftentimes you'll see less liquidity, because quite frankly, there's just a little bit less activity, and how the markets kind of put up a defense for that and try to get more liquidity is they reduce the number of strikes, they reduce the number of expirations available to kind of drive activity to less and less places.
Yeah, I think that's a really good takeaway here, because we always say these are more stable in nature, but there's obviously good reasoning behind that, but we will leave it there. Now, coming up next, we will talk our FOMO discussion. That is naturally all things Nike, although not enough to propel the Dow higher throughout the session, as we have seen this name pull back about $4 from its intra-session high. All in all, results better than feared. We'll break those down coming up next.
engine. Some estimates even have them closer to 20 billion. It's certainly something that the U.S. Justice Department is focusing on. Their critics say that, it stops competition. It's preventing some of these other search engines from getting to Google's level. At the same side, Google says that they pay those funds to companies like Apple in order for them to do security updates and software maintenance on a timely manner. Is there a search engine threat here from Microsoft to Google? Certainly looked like there may be a little bit of pickup around that when ChatGPT first hit, but I think you can look at Google stock, that concern is really mainly flown away.
Yeah, and I think right now the concern for most when looking at these names is the pullback we've seen in shares this month. Although, ironically, with this news today, both the names ever so slightly higher, even with the overall market sort of being lackluster on the session. But we will leave it there. Great breakdown on what is an interesting story regarding all things Bing, which I will say to me is just like the dwarf to naturally all things Google. But Jeff Pierce, Senior Manager, Derivatives Trading for Charles Schwab, thank you so much for your insight as always. Now it's time to bring back in Alex, and we're looking at our FOMO name. That is Nike, arguably one of the strongest moves on the session, even with it pulling back off of session highs. I mean, shares were over $99. We're trading now just around 95, 96, we'll call it, nearing there. Still making a 7% move to the upside, and we both said nearly the exact same thing on futures, so we must have been discussing this yesterday, which I believe we were, that we felt like it was just a result that was sort of like the relief rally, right? Because the earnings weren't exactly that strong, just better than feared.
I feel like I can take a victory lap. I think I've been saying this for 2 weeks. I've been saying that, when you have everything lining up for bad news, the stock sells off into it, it changes the dynamics as to what the expectation actually is. And Nike couldn't have delivered a more lukewarm report that just reissued the exact same guidance as unchanged, and that was seen as a positive. That's only possible if the expectations were that guidance was going to get slashed and this was going to be a bad quarter. And those were only the expectations because that's what everybody told you before we had this quarter. And so we looked at this from trade illustration standpoint to conversational standpoints for the weeks leading up. And this was the point that I think I made every single time we talked about it.
Yeah, I mean, I could not agree more. I'd say the fact that management's commentary suggested a better environment than many had feared, that's the brightest point of this report. Just goes to show how beaten down this stock was into this print. I mean, we did see that Nike's positive commentary on trends in North America was something that was received well by the street. We also saw marketplace inventories were down double digits on a year-over-year basis, so they are improving their situation as far as an inventory standpoint.
Wow.
But
All a royal flush.
Nothing that excited me that much as far as like beats go. Their revenue did climb 2% year over year, but
I'm bouncing off the lows here a bit.
Did reiterate a hold rating, a $100 price target.
Because I'm trading my second string account, trading tomorrow's options on SPY, so I have been actually averaging down the calls, try and get out of it by end of day for a move maybe to VWAP.
This report was a mixed bag. While the bull versus bear
Not the best strategy.
will persist pending into greater clarity on wholesale recovery and macro uncertainty, they do still say Nike does remain the dominant footwear brand. Goldman lowered its price target to 136 from 145, kept a buy rating though, saying against a backdrop of negative investor sentiment, the print was just better than feared. Pretty much took the words right out of our mouths, Alec. Looking ahead, they do say Nike's commentary on innovation is strong. Management calling out plans to accelerate its innovation into the Paris Olympics, and the evolution of their Air Max platform across both performance and lifestyle was a bright spot. This is still, to me, the global leader of all things athletic wear. I'd say particularly shoes, although I will say that anecdotally, both Tom White and I were discussing this name. I haven't shopped at Nike in, years, but that's just not my preferred footwear. Like, it's just not what I run with, so I'm a little bit biased. But I will say that from a global standpoint, that swoosh does still have brand power. It's just fighting in a very, very saturated market. There are so many new players in this space. We talk about On Holdings, which has become very popular for, I know, various runners. We talk about several other brands that do compete with the Nike in terms of athletic wear, like a Lululemon. Under Armour is another major player internationally. Adidas, another one that, I mean, these are just some of the publicly traded names. And we look at names like Alo Yoga, which has become up and coming. Outdoor Voice is another one. So there's so many brands right now competing for a share of this athleisure space. I cannot argue that Nike has a great job with partnerships and brand deals, and athletes do wear Nike, and that's a huge thing for the brand. But as far as competition goes in this space, it's challenging, I will say.
It is. It's still the top dog in this space, particularly when it comes to shoes, which is still the overarching majority of where it gets its revenue, about 2/3 of its revenue from Nike, of course, coming from shoes. So other names are, have it in the crosshairs, particularly Lulu has probably been very focused on what Nike's doing, and in many ways they've out-executed them on the apparel side. But Nike's still that brand that if you're a kid growing up, if you're maybe a young golfer, if you're a fan of Rory McIlroy or Tiger Woods, I mean, that's the logo they're wearing. If you're a fan of, basketball, a lot of the key players in the NBA are wearing Nike shoes or Jordan shoes, which of course falls underneath Nike. So they still have that superstar-driven model. They sponsored the jerseys for many of the major athletic leagues. So many licensing deals, so much Nike in your face all the time. It's hard for this company to really struggle, but the bar's always set high except for this quarter. That's why it was so interesting. But going forward, I mean, just because the bar was set too high or too low once doesn't mean that you just can clean the table clean and start fresh. They still have issues they're dealing with, China being one, cost pressures being another, supply chain continues to be an issue. Some of the positives, though, lower inventory levels. Inventories building up has been a killer for so many retail names, and Nike working through some of those inventories.
Yeah, that was the objectively to me the most bullish takeaway of this report. We also are seeing strength in names that are related to Nike, like Foot Locker is getting a nice 2% lift. Under Armour is also higher in the session. Lululemon with a 1% gain. So, in spite of the market weakness, Nike is propelling some of their closest competitors, if you'll call them that, higher on the session. Trading this name, though, I will say FOMO feeling definitely feels maybe to the upside today. If you zoom out, doesn't necessarily feel as FOMO-esque to the upside, but all things considered, 7% move higher on the session. Yeah, it doesn't feel like that beach ball held into the water that's just being held back from, exploding higher necessarily, but it does seem like something that's been, beaten into the corner and it's kind of pushed back here a little bit. And so I looked at a strategy that looks for some upside, but not necessarily a runaway upside. So looking at a skewed call butterfly in this name in which we go out to that October expiration, Jenny, buying one of the 94 strikes, selling 2 of the 100 strikes, buying 1 of the 103 strikes. So buying a $6 wide spread, selling a $3 wide spread, done for a $2 debit. Break even would be 96. Because of those dynamics in the pricing and the widths, this thing can make $4, but only gives back 3. So even if this stock were to run through 103, it would level off for a $100 profit, as you will see when they pull the risk profile up here for us. But bullish strategy with the best case scenario being a move to the short strikes, as the risk profile shows. Right at 100 is the best of both worlds, in which the credit spread would potentially expire worthless, and that debit spread can work towards full value. That can be a max profit of 400, not the most likely of scenarios, but certainly a scenario. And as I said, no theoretical upside risk. It just levels off for a theoretical profit of $100. So $200 in risk if this does fall below 94. That is absolutely possible with the stock at 96 right now. It is right at the break even. $2 in risk to make a potential between $0 and $400. Right, and I am impressed with their ability to hold on to this near 7%. Now actually at 7% gain on the session, just again with some of the market crumbling here. But we'll leave it there for FOMO. Now coming up next, we will stick with our theme of talking moves to the upside. Blue Apron with an outsized move to the upside. Shares are up 133% on some takeover news. We'll discuss a name that I would have thought was left for dead, but seeing some M&A interest. More with Renita Young coming up next. understand the pre-made meals because that saves you, I mean, a plethora of time. But some of these meal kits, like I believe it is Blue Apron, they just give you more of the ingredients. So then that to me is like, you pay a premium for this, you could basically be buying these ingredients yourself. Is anyone still using these?
That's a good question, Jenny, because I know the people who maybe would have used this in my life, they need convenience and they need to save time.
I get that too.
Yeah.
I get that.
And so on one hand, it's saving the time that you would to spend going to the grocery store, but it's not saving time cooking. So I guess it depends on which, where you want to save time. And whether or not you should just get a service that will deliver a cooked meal for you.
I think there's one more piece of this too that we're missing, which is some people don't know how to cook, and this helps you get there. This is like buying the Lego kit with the instructions, and this is the same thing that I've said about the curated kind of designer boxes of clothing, your Stitch Fixes of the world. At some point, you accidentally teach your customer how to do what you're doing for them. At some point, you do Blue Apron for 2 or 3 weeks, you kind of figured out how to cook, and you can now go to the store and buy the exact same ingredients you just had for those recipes. So that's always been the issue that I've seen with these companies, not to mention the fact that I'm sure there's been a little bit of shrinkflation. I'm not going to accuse them, but it seems like those portion sizes getting a little bit on the small side.
Yeah, you're right.
I don't know how you're going to get full off of like a half cup of rice.
You're not, but here's the thing. Those are the normal portion sizes that we should be eating probably. I don't know, I wouldn't use the should word, but those may be the more, but you bring up a brilliant point about that. They're teaching people how to cook, right? But I could see in the future, maybe they're watching, right? This being like a matchup with Bumble, right? So you have a date and you buy a meal kit and you cook together. That can be something.
That's a really good. See, that's a great way because I'm like I do like to cook and I like to go to the grocery store. So this is a concept that is so lost on me because I'm like, just go buy the ingredients yourself. I mean, Google is a great tool.
Yeah, no doubt about it. With this actual story, though, with the actual merger, the acquisition here, as you guys said, massive repricing today. Takeover price being listed at 13. When you see it start bumping up against that 12.83, we're getting pretty close, given that we have 5% interest rates right now. The market's saying this is a highly likely deal in terms of going through with approvals and probably going to go through relatively quickly. So while they have that earnings on the horizon, this one's largely off the board until we get a deal update. Something were to break through on the deal, maybe you see a big repricing to the downside. Otherwise, $13. That's where we're headed.
That would be a pretty good premium on shares. Absolutely.
Because we're still, even with a 133% jump, still above where we're trading. And I think this is a greater story that it shows that some of these names that got some pandemic relief could be seeing their valuations still further reset. I mean, another concern is Instacart just went public. They saw a huge boom during the pandemic. And now, even with their public offering, it's been a little bit disappointing.
Oh, yeah. So we'll have to see that. That's been happening with the last few public offerings that we've tracked here. So we'll find out how the progress with this one will go if it indeed goes through its IPO quickly.
Yeah, and an interesting move, no doubt. I can respect a massive triple-digit move to the upside, but go get your own groceries.
And briefly, I said go through its IPO. We're talking about its merger, obviously, not an IPO.
Correct. IPOs, M&As, it's a Friday, but go get your own groceries and make your own meals. But now, thank you, Senior Markets Correspondent for the network. Now, coming up next, it's time for Under 30. We are looking at Ford as we have gotten news that these strikes are going to continue. How does that impact Ford shares that are down a little bit over 1% on the session? We'll discuss more coming up next.
Coming down again. We're getting the same flag that we had here, right here.
as the VIX has now moved higher. In fact, it's up now 1755, and that certainly is worth noting. For some of the stories that are big in the markets today, Caroline Woods is joining me, senior markets correspondent here on Schwab Network. And the first is all the details on the UAW strike. It continues. What's the very latest, and what are you watching when it comes to that?
Well, we're heading into week 3 of the strike, and it's expanding. They're now targeting more GM and Ford plants after failing to reach a deal. Stellantis not named in this expanded strike because they're apparently making some progress on their negotiations, but keep in mind that doesn't mean they're out of the woods, because last week Ford was spared, and it seems like now they're back on the UAW's bad side. So the additional strikes will target Ford's assembly plant in Illinois, which makes Ford Explorers and other SUVs, and then GM's Lansing, Michigan plant, which is focused on Buick and Chevrolet models. So another 7,000 union workers will join the current 18,000
All right, Jay, I'll take care of it.
UAW workers across the U.S. that are on strike. So bringing that total now to 25,000 workers on strike. That's about 17% of the 146,000 UAW members across the 3 automakers.
GME's down 2% here.
The expanded strike, though, it's important to note, still is avoiding pickup trucks, which of course is Detroit's biggest moneymaker. So a little bit of restraint there. I will say GM has come out and said we have still not received a comprehensive counteroffer from UAW leadership to our latest proposal made on September 21st. Calling more strikes is just for the headlines, not real progress. Adding, our current record proposal that is on the table offers historic wage increases and job security while not jeopardizing our future. So clearly getting pretty frustrated on their end. Dan Ives, of course, a big Tesla bull who had said Tesla, on the network, that Tesla was the one to stand to benefit. He was out with a note earlier saying it's like watching a slow-moving car crash on black ice.
Apple's already had a big sell-off.
GM and Ford, as both 3 and 3 stalwarts, are in the early stages of a massive EV transformation for the next decade that will define future success.
It's got a ways it could go still.
This crucial period of EV execution, model rollouts, distribution, marketing, with EV competition rising across the board, the timing could not be worse. So just taking a look, GM and Ford both down right now more than 1%. Stellantis is also down about 1%. That being said, GM's only down about 1.5% this month. Ford and Stellantis actually up on the month. They're in the green for the month, which can't be said for a lot of other stocks. And Tesla was up as much as 1% just a bit ago, now up about, call it 0.3%. It's but down about 4% on the month.
Yeah, well, it's pretty amazing when you see them holding on to the green when the market really has turned into the red now over the last couple of hours. I mean, now we are significantly to the downside with energy, financials, communication services, healthcare, all really weighing on the
wondering
market.
if the end of the month is getting some rebalancing or something.
Another thing that's holding on to the green is Nike. Pretty amazing, and in fact, it's gained over the last since my last show.
Oh yeah, those big 3.
7%. I know it's off the earlier highs.
That's right.
Of the
I don't know.
earnings report, and people are really questioning now: has Nike bottomed? And talking about upside potential.
And it's despite a mixed
Ford never
earnings
goes anywhere,
report.
so
Beat, but revenue actually missed. But I think investors really focused on the inventory improvement and improvement in China, which of course was definitely a worrisome spot for Nike heading into this report. EPS of 94 cents, so easily topped analyst expectations of 76 cents per share. Revenue rose 2% to $12.94 billion. As I said, that fell short of analyst expectations. The first revenue miss in 2 years.
No.
But if you take a look, sales in China rose 5%. That
based in the Netherlands, the holding company?
Weaker than that was previously expected, but they are seeing signs of life there. Nike CEO John Donahoe said sport is back in China.
Bullish.
You can just feel it. He talks about feeling good with their position there, so some bullish commentary there, and also said that despite the fact that China has been highly promotional, it hasn't impacted an improvement in full price sales for Nike. So I think that's very key. Meanwhile, in North America, sales fell about 2%, but actually topped expectations. EMEA saw an 8% uptick in sales, and then Latin America and Asia Pacific sales rose about 2%. That was slightly below estimates. I mentioned inventories. Those fell about 10% to $8.7 billion. Nike said it's comfortable with its inventory levels, so definitely some improvement there.
Gross margins did fall slightly, but still came in better than expectations. So that's also good news. And then the outlook, they're maintaining their full year revenue outlook of revenue to grow in the mid-single digits. So that's in line with what analysts are expecting. And then also talking about some gross margin expansion by 1.4 to 1.6 percentage points. So good news there. We have seen some mixed commentary from analysts. There's been some price target hikes and cuts for the most part. Analysts, about 61% of analysts are in the buy camp for Nike, but the median price target has come down to $120.50 now, which still implies quite a bit of upside, currently trading around 96.
Right. All right. Thank you for all of that. A lot of names and things to watch. Appreciate it. Caroline Woods. Now let's take a look at the bigger picture. James Locke's with us, co-founder, Pool Lock Associates. Thank you for being with us. Before we get to some details and some names and strategies, look at what's going on. We're ending this quarter, a tough quarter. People are saying good riddance. The S&P, for example, down nearly 4% in 3 months. Your thoughts?
Like you said, good riddance, right? And to really kind of top it off, the government may shut down on Monday, which is not going to help, anything in the markets. Anytime there's instability in anything, particularly, let's just say in Washington, D.C., that's not going to give confidence to the markets that things are going to help. Now, while it's bad here in the U.S., it's worse internationally, and we've seen that, although not much. But that's really being led by China and real estate problems down there and their lack of effective stimulus, package on the international side. But we're seeing, Treasury bonds surge, and rightly so. There's fear. We don't know what's going to happen with the government on Monday. Right now, it looks like it's going to close. Oil prices,
Yeah. Sorry, I thought you were.
Everything's down today, and I think today it's just a lot of the tide is pulling everything down a little bit. But oil is going to remain strong. We're going to see oil keep climbing. With the slowing consumer spending and double whammy on top of that, student loan payments are going to restart. October is going to lead to a lot of volatility. That's what we're going to see.
Right, understood. A lot of the traders I speak to, they watch like these crucial levels, right? We had 43.50, we broke down below that. The next one they were watching was 4,200. As we began to sink, it started to give it a go. We were getting closer up to 4,300, but now we're back down again at 42.79. You're even looking at 4,100. Tell me how we're going to get there, and is that by year end?
That's year end. Yep, that's year end, and I think October is going to drop below that for sure, just in volatility movement. But there's nothing out here indicating that this market can take off and really push that to that 5,000 level. Let's just say because the Fed keeps beating that drum of threatening to raise interest rates. Now, I don't think they're going to do that. And hopefully they don't, if you never know. I don't think they're going to do that, but we're not even going to start to hear chatter about, interest rate cuts until mid next year. So with them keep on, threatening to raise rates, that headwind against all markets, I don't see how this economy and this market can pick up in any reasonable way, which is where I think we're going to end up a little bit lower than we are right now. Honestly, today was a little surprising, especially with that good, inflation news.
Right, the PCE came in a little cooler than expected. I mean, the price pressures basically eased to the slowest pace in 2 years, and much of the print was in line. It was what we expected, right? You can call it Goldilocks or whatever you want to call it. Nothing to really jostle this market. So why a sell-off today? Is this just a little exhaustion? I mean, energy is the worst performing group. In fact, energy down over 2%, but financials right behind it down 1%. Why a sell-off like this, which now really has gained steam over the last hour or so?
Yeah, people are just fearful. The market was up pretty big and has been selling off. You're going to find a lot of people, taking money off the table. And the fact is, cash is now competitive with the stock market. If you can get 5% in a fully liquid situation, people are willing to sit on the sidelines, and that's not helping anything at all. So we're going to see that continue to trend until I think the government has to get themselves straightened out first before anything else can happen. We're encouraging our clients to really stick in that, what I call that fixed income sector, but like bond and bond-like instruments, making sure that maybe we're stretching our duration out just a little bit and focusing on things that are going to pay us some more in the long run, while we kind of tread east to west in these markets now.
All right, let's get to some names you like here. We recently had Kenvue here at the New York Stock Exchange. Yep. That was spun off from Johnson & Johnson. But since we've had news on Carnival Cruise Line, and that's a more widely held stock by folks, let's start with that. You like that name?
I do, and they did come out, beating today. They it was positive. Things are trending in the right direction. Travel is getting bigger. There's a longer sales kind of curve with cruise lines between booking and things like that. I think that not just Carnival, but all cruise lines are going to be able to slow down on their marketing of the message of saying, hey, it's okay to travel, because that's been pretty well pushed forward. So you're gonna see that trend continue, but they're, marketing and things like that, they're going to need to fill these rooms are going to be less and less. Now, again, everything's getting beat up today at Carnival, included from my point of view. That's just, I liked it this morning. I like it even better right now.
Oh, all right, I get it. And what about Kenvue here? We're looking at around $20. It's been on a downtrend from $27. Is this an opportunity to pick it up today?
It is. I like it to go back up somewhere in the 25 to 28 range. These are our brand names, things that we've all heard of. Listerine and baby shampoo, Tylenol, things like that. But the good news is there's no liability to that whole baby powder, talc litigation, right? So they've kind of skirted that problem. Again, nice dividend yield, 3.5% here. They're going to be added into the S&P 500. So I expect them to pop up into that 25 to 28 range.
Yeah, understood, because then you'll have all the money managers tracking that index and having to buy some too. Yes, yep, that's a good point, James. I'm glad you brought that up. James Locke, Pool Locke Associates, thanks for being with us. Thank you. Thanks so much. 4,100 end of the year. Wow. All right, coming up next, we're watching Nike, which is seeing a bump after its earnings report, and it's jumping about 7%. Has Nike seen the bottom? Plus, potential upside for Meta. Much more to come right here on Schwab Network. We'll be right back.
Yeah, that was ugly. Ugly all in. I mean, playing pretty awful. Or just not in good hands. I don't know. Number 6s, what the heck? GME is down 2%. Barbecue down to 7.5 cents. Suppose I should raise that since I have a bottom pair. Maybe this guy doesn't play so loose. He's down because he wants me to see you. Let's see if the bottoms here on the SPY are starting to round out. No black cards. What? Make sure not give me a straight or anything. AMC's coming down a bit. It's gonna fill that gap. A red. Pretty large daily candle here. That big of a wick we can get on the bottom. An engulfing candle yesterday. I think we're probably still climbing up. Not easy though.
Funds repositioning right now for the fourth quarter, which starts Monday. So, you know, I'm not surprised with what's going on right now.
Sure, it's the end of the quarter too. Yeah, we're getting like some rebalancing.
Move towards the end of the year, the market's going to be quite a bit higher.
Portfolio rebalancing. We might might have an explosive end today, honestly. It's not like ETF rebalancing, I guess. Maybe not.
There is some talk that Nike has hit a bottom. You know, I know that they had a rare revenue miss, but there were some good points in that report. And in fact, one of the analysts I had on earlier said, look, with the cautious view we got from Foot Locker, I thought Nike was going to be a little worse than it was. Your thoughts on Nike and where you think Nike could be headed? Right now, it's trading around $95, $96 today.
Right. So, I mean, I think that there's definitely potentially some really nice upside here on Nike. You know, it's trading I think it's pretty much bottomed out here. That's just my opinion. But the inventory levels definitely look better. Inventory levels were down close to 10%. Nike's been off 23% year to date. And let's not forget that Nike's off 50% off its all-time high, which was set a couple years back. Nike's working on advertising and direct sales to help the consumer and be more profitable. And, with the holidays around the corner, I think that Nike could be a really, really good value. I think the stock could see $120 a share, probably in the next 6 months, but I think it's going to venture quite a bit higher as we move towards the end of the year.
Right. What about Meta? Is Meta a name you like? I mean, when I was looking at the Magnificent Seven this morning, when the market was higher, I saw a lot of up arrows, and I said, wow, these things are really just relentless. They won't give up. I know the market has turned into the red over the last couple of hours, and I haven't checked all 7 of them, but your thoughts on a name like Meta? Does it have room to go to the upside now, and why? How much?
Yeah, I am. Meta is one of my favorite stocks, and I've been recommending Meta for probably the last 4 or 5 years. And we did get hammered, and the market and the stock came back quite a bit. Meta is an early adopter here with AI, and AI is going to continue to grow. We're in the first or second inning here. They're an early adopter. The company's, in my opinion, is going to do very, very well. And with regards to the digital ad space, which they pretty much dominate right now, that could triple by 2030. So I feel that there's a lot of room here with Meta, and the valuation. They could eventually be $1 trillion stock. So I see tremendous upside for Meta.
I understand. And what else am I missing? I mean, when you think about the Magnificent Seven, were there other names in there that you like, or is it a Tesla or AI or anything else that you're dabbling in?
Well, I mean, I like, obviously, most of the stocks. I like Amazon, and I love Apple, and I love NVIDIA. I think there's a lot of room to grow here. The market right now, is a little bit under pressure, but like I said, this is the time when you want to look and pick some of your favorite stocks that are down. Apple's been down, and nibble on these names while the market, sees some uncertainty here. But I really think that earnings should look good next year. I do think rates will come down, and hopefully we're going to get past the phase that we're in the market right now. So, the market's held up, in my opinion, pretty good here.
Let me ask you this. If we do, in fact, get a government shutdown,
I might be breaking that upward channel.
It's going to be on Monday. Do you think the market could sell off in a big way in something that would be sizable or notable?
I really don't think so. It's going to be the first day of the quarter, and I don't think it's going to be a huge sell-off here. Obviously, we're going to have to see what happens.
Maybe being priced in quite a bit today. Shut down the market,
but,
so might get a big gap up on Monday.
Having a major sell-off here.
It's open.
We've been moving nicely throughout the year.
Balzer puts on GameStop? Neither.
Year. And September and
We're just
October
asking.
historically are volatile months in the market. And,
it's on a long time frame. It's quite low, but it's breaking.
So
it's
I'm
hitting
gonna stick
resistance
with
and
what
not
I
breaking
think,
out. So
and, I
you
feel
get
pretty
puts, but
positive towards the end of
your
the
risk to
year that
reward
this
isn't great.
market's going to move a lot higher.
All right, good to see you. Andrew Aaron, Synergy Advisory Management Group. Thank you for being with us and some of those picks as well. Thanks.
Unless you want a ton of time,
Still ahead, all things about
you're gonna get leaps.
Tesla and the other names as well. Steve Wesley
You can go either way, honestly. Leap puts, leap calls.
The UAW strike, and just the big picture on U.S. automakers. What do we need to know? Steve Wesley next.
Still 15 for the break. All right. Yeah, if you have enough time. If you already have a bunch of shares, you could get puts. It makes more sense. Jeez. Threes, flush. Don't have one of them. Hey, air kicker. Rays on the river. $230. Spy's coming back down. The top of a channel. Flush. $20,000. All right. Thanks, Tasty. Appreciate it, man. Fake letter from RC? I didn't even see it. Maybe he's not doing all that awful, honestly. Market's pretty bad across the board today. On Twitter? I don't know what it says, but it doesn't look like price action from the news on GameStop. No, I think Jimmy's just down with the market. He's gonna flush some more here, I think. Or we get a bounce in this double bottom. Flush. Sounds good, Tasty. Thanks, man. Flush out there too. House out there. Flush or straight? Flush. Ace flush. That happens when you have like 7 people seeing the showdown. I don't know. I don't think if the government shuts down, we're going to see a crash at all. It'll be pretty flat if it's shut down. If it's open, we could see a rally. I think we're getting that priced in right now, the shutdown. Not to even say like a shutdown necessarily causes a big crash or sell off. Thanks, gods. Appreciate the pizza party. Don't know. Much appreciated, man. Hope you had a good week. We are gonna need our energy. Party Friday for sure. Ready. My body's ready for all that gluten and carbs.
Let's get nuts!
Ooh. You know, if I'm from my phone. Sometimes you do really well doing that. Don't make irrational decisions. Have a plan. You come out. You set up. You execute. Don't look at it. Have a plan to exit. Yeah. I wish I was more actively trading when I had more, much more busy schedule, I guess. Or passively, I guess you would say. Passively trading, but I mean, I can't, like the Theta farm mixed with the 5. Busy saving money, exactly. So good at overtrading. Wiped out from this week. I don't know why. Today sucks. Yesterday wasn't bad. Day before, I had one quite good day this week. This day. Day before was alright. Wednesday I think was good. Today slaps me back into humility. Breaking my rules today. It's not necessarily like rules. I mean, it's just, yeah. I don't know. I have to review and see what went wrong. I don't know. Day's not over, but I don't like where I put myself.
Converting into as healthy organic profit growth as it should have, and that's because of the cost pressures that it's gotten externally and then the higher cost of doing business. Margins have been pressured in recent years because of that, but now the analyst says that AB InBev's margins are at an inflection point. The costs of goods sold pressures have started to ease, and now the stock is reflecting that more than $1 billion profit hit from Bud Light. And she says that now there's a more clear portfolio strategy for the company. But Bank of America says it's really hard not to be negative about its U.S. volume outlook. Now, shares are down more than 7%.
See some end of the quarter rebalancing.
They're up more than about 20% over the past 12 months.
Green volume candles.
Yeah, you know, and as I'm looking at year to date for Sam Adams, for example, that's up 19%. And don't forget, Bud just got squashed. And some of those other names really benefited, like Corona and Modelo and Stella Artois, some of which Bud owns and some no. And so they definitely had an uphill battle, but nice to see an upgrade there. Renita Young, good to see you. Thank you. Cheers. Okay, taking a closer look at the restaurant segment, Nick Setien's with us, Managing Director, Restaurants Equity Research at Wedbush. Thank you for being with us. So, where's the potential opportunity? Sit-down restaurants, are we back?
Well, we're not back yet, but I think the valuations have contracted enough to, essentially bake in a whole lot of bad news. And so, I mean, over the past 15 years, there's only been 3 other occasions where full-service restaurants have traded at as big of a discount as they're trading now. Only 3 other occasions in 15 years. So, these restaurants are screaming recession, and even though we are cutting our expectations, both in Q3 all the way through 2024, we think that's more than baked in.
Yeah. I mean, a name like Darden, for example, that's the parent of Olive Garden and others. That one you think has potential. It's well off its 52-week highs. Your thoughts?
Yes, I do like Darden quite a bit. You know, they reported last week, so I don't think there's any need to cut estimates this week. Essentially, I think the expectations are realistic going forward, and if there is a very dire recessionary type of scenario, you know, their scale is going to protect them from having to cut margins too much. So I like Darden very much.
Yeah. What about Texas Roadhouse? What's driving Texas Roadhouse going forward?
Well, with respect to, you know, Texas Roadhouse, they're the primary transaction share gainer within the category. You know, even though I cut my estimate for Q3, I'm still expecting 3% plus transaction growth. And that's going to sustain, you know, to slightly lesser degree, but still positive transaction growth going forward. And I just think ultimately, you know, positive transactions in this environment is going to trump.
Spy starting to wake up a little bit here.
With that name, particularly on margins and beef costs.
Sometimes, you know, when we count the foot traffic,
I've already averaged down. I can't average down anymore.
Traffic, but also the check and how much that was for. So, you know, if you have a few people coming in and they're spending like crazy, that's great. But you need more people to come in because they're not spending like crazy. And I think people are starting to pinch
Market
the
goes up on a
purses,
shutdown.
but are they
Yeah,
having
I think I've heard something similar to that as well. Dang it, I just folded this.
Or are they pinching
They probably has a straight.
Yeah, you know, we call it attach rates, and we are seeing attach rates come down a little bit. We're seeing alcohol incidents, you know, decline a little.
Yeah, we're not hemorrhaging money
too much, right? I mean, Darden, for example, last week talked about a little bit of a you know, step down. But
double had this trade. Two fours.
Concentrated in the higher end, very high end fine dining concepts like Capital Grill and Eddie V's. So, you know, for the typical casual diner like an Olive Garden, like a Roadhouse, we're seeing it slightly. We haven't seen it get to levels where I would you know, particularly worry about it.
Right, understood. You know, when costs are on the rise, I mean, oil is up about 30% in this quarter. I mean, if you have transportation costs and you're moving goods from point A to point B, you still have somewhat inflationary environment. I think the whole industry still has a squeeze to a certain extent. They've had to really cut costs. The other names you have here are Chuy's and BJ's, both winners too. Would you buy those at this point?
Yeah, I would. I think Chuy's is gonna, you know, have their 19th quarter now straight of beats, and you know, despite it being a very small cap restaurant, you know, I really think they have a really great management team, great growth path ahead, very profitable growth path ahead, and they're trading at a very compelling valuation. You know, BGRI, we are taking down our numbers both for Q3, Q4, and 2024. But again, trading at a 5 times EV/EBITDA multiple, I think a lot of that bad news is more than baked in. So I think it's time to take a look.
Is there the other side? Is there a name that seems to be struggling, or just you haven't seen what you wanted to see from a particular name in the group?
Well, the few neutrals that we have, like a Brinker, Cheesecake,
10 offsuit, definitely an all-in cards.
I'd say, you know, Dine Brands is probably the one losing the share. Is probably the greatest share donor at the moment, and they also have, you know, probably the most levered balance sheet, unfortunately, and they do have some interest rate risks as some of those refinancing issues start to come up again. So I'd say, you know, Dine Brand is probably the one that's least well positioned in the near to medium term.
Right, understood. It's great to see you. Nick Setien of Wedbush, thank you very much for all the details on all these food companies. Casual dining, we should call them. Thank you so much. Good to see you. Up next, Carnival Cruise Line. So the shares are dropping after the quarterly report. Fuel costs are one thing that cruise
I just wanted to get a re-up on my chips.
Let's take a look. Our panel is ready.
Nail the full house. I should have probably folded that. Didn't have much. Alright, Jay, sounds good, man. Anybody to go and have cards. I even checked the king. Erased it, I guess. He's not ready to rally. 10 minutes till power hour. I just don't know if we're gonna get that rally. He already has a straight. Must already have a straight. Checking. Oh, three of a kind. I guess he could have had a straight. Would have been, yeah, one off. I guess I never got straight anyways. You did get lucky. Dude, he was raising pre-flop with a pair of fours? Gosh. Or no, that was on the turn. For the flop. No, that's good, Bobby. You do that, man. Did your puts work out? You're way far out of the money. Happy you made money today, Bubba. Probably a flush anyways. Yeah. Oh, two pair. What? Oh, there was a pair out there. Yeah, I know. It's hard hearing sentiment against what you believe. Stay clear-headed. This guy's still calling out fast. 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 Jeez. Never bet I try and bluff. Oh my gosh, he had nothing? He had nothing. You even have a low pair. He called the bluff with no bluff catcher. Alright, climbing up a little more here. A lot of hands out there. Oh, he didn't have a kicker. Is that why? Too low. I'm starting to rally a little bit. Got spades. $10-8 with the bluff. Oh, you did have spades. Well done. Oh, he had a straight, huh? He had a straight. Go spy. Wake up. Wake up, wake up, wake up, wake up. It's the first of the month. Oh. Or twos. Alright, it's fine. Probably start selling a view up. on my trading account today. Trying to save my second string account. Or have fades. Oh, pair bad kicker. Yeah, 2 pair. And the ace the whole time. Trying to slow player. Lack of experience. Fly climbing some more. Still won't be break even at BWAP. Average down a lot on it too. Way more than I'm comfortable with. That's not true, I should say. More than I should have. But really not enough because I'm not break even yet. I'm holding the full house here. Checking it through. Kicker, man. Hearts got there. Another kicker. Lost to a kicker. Our hours here.
It did not bring the outlook down. All in all, though, this report was really better than feared, Caroline. And the company does have plans for accelerating innovation into the Paris Olympics in 2024. And Nike is going to be evolving the Air Max platform across performance and lifestyle. So those are a few things that Nike fans have to look at. Now, it's getting some mixed reaction from analysts, but largely bullish still. Deutsche Bank raised its price target to $125 a share from $122, kept a buy rating. Barclays actually cut its price target on the stock to 119 from 124, but still kept it at an overweight rating, Caroline.
Yeah, the majority of analysts still bullish on underwhelmed all year. So the 7% gain helping give it a nice pop to wrap up the month, but still down 5.5% on the month, almost 18% year to date. Different reaction for Carnival earnings today, though. Shares, well, I shouldn't say sinking, but shares plummeting after their earnings report. What has investors so downbeat in that report?
So earnings and revenue actually did beat the Zacks estimates, but it was the outlook that's got shares sinking today, actually. Sliding, we'll say, sliding. But right now, the company did manage to have some strong bookings volume as well, and that's what people are kind of excited about today. And it reduced its debt by nearly $4 billion. That's substantial because Carnival, along with its peers, had taken on a huge load of debt during the pandemic, and they've been trying to dig themselves out of that hole since then. But adjusted earnings came in at 86 cents a share versus the 73 cents expectation on revenue that was $6.85 billion. That was above the estimate as well. Total customer deposits
folded. He was bluffing.
$6.3 billion. And we knew heading into this, by the way, that fuel would be significantly higher for the company in the coming quarters. Yet Carnival Cruise Line said that it would not have a fuel hedging program. Now, looking ahead, actually, by the way, I did hear just on the watch list in the show ahead of ours that one of the analysts talking about that fuel hedging program talked about just how expensive it is, and companies have to do a lot to even make that program go. And if it's a company that's trying to lower its expenses, maybe that was on the chopping block and it made sense. But looking ahead, the company is expecting occupancy at 101% or higher for the fourth quarter, but it's expecting an adjusted loss per share of between 18 and a loss of 10 cents for the next quarter. This is not good, especially since the company saw its first quarterly profit since the COVID pandemic.
Okay. All right, well, shares down about 6% right now, still up almost 70% so far in 2023. So only paring a small portion of those losses or of those gains today. Renita, thanks so much for filling us in on Carnival and Nike. Coming up, we'll be joined by the CEO of YWCA USA to discuss the WOMN ETF.
What are all those acronyms?
Empowerment ETF. We'll learn more about it and the type of companies in the fund next.
We get a full house. I guess a queen could beat us. I'll just take folds even. He had a pair of nines. Oh my gosh. They're playing very loose. Man, SPY's coming back down. Lucky, lucky, lucky. Maybe get some folds. Nope, lots of pockets out there. Pocket jacks, pocket nines, ace 8, 6A. Full house, congratulations. Five ways to an all in. Guess you could have a full house here? Otherwise it should be a chop. Doesn't have anything. Slow played him a little bit.
thoughts on where the work from home environment is going in the future. Market on Close. We'll be right back.
Oh.
work we do at a desk all day. You know, I think people are being forced to return to the office because they often have bad managers and those that lack vision, and they don't really know how to manage. So they manage by things like, you know, FaceTime. Whereas, you know, I think we've seen that folks that have kind of more disciplined, thoughtful management styles, you know, can perform perfectly well with fully remote and distributed teams. And I think on a long enough time horizon, you'll kind of see the spike in remote work. It'll, you know, come down and settle, and it's already actually settled, and it's already starting to grow again. So I think, you know, we're playing on a 20, 30-year time horizon, and you know, so are our customers. You know, most of the folks that are we're working with large companies, you know, KPMG, all the large four consultancies, lots of large contact centers, actually, which is a market Zoom is trying to get into, are using us because, you know, they moved to distributed workforces, and they're not going to go back.
So I want to know what makes me a more collaborative, more productive worker on Kumo Space than it would on some of these other platforms?
Yeah, well, so the concept of a video call for a product like Zoom or even Microsoft Teams, it's sort of ephemeral. It's a scheduled meeting, right? You have to, I don't know, text someone or Slack them and say, hey, are you available? Or let's set up a call, or we just finished a meeting. Let's set up another meeting 2 weeks from now. And what you end up with is, you know, your week starts and you've got 30 hours of meetings already booked and no time to get anything done. Kumo Space is different. We basically are persistent office space. Folks roll into our virtual office somewhere between 9 and 10 a.m. a little on the later side. We are a tech company. And then they're in our virtual space for 6 to 8 hours a day. And what that enables them to do is tap folks on the shoulder. If you need help with something, you can just instantly get their attention. If marketing is running a meeting and one of the developers wants to come in and ask them when they're going to, you know, be ready to launch the new feature, they can see that meeting going on. They can see what the folks are screen sharing, and they can just jump in and get a quick answer to their question. Or even if a meeting ends and then some folks want to stay and talk or break off into small groups like you would in real life, you know, in Zoom, you just instantly disappear and, you know, you're staring at your couch or your bed all of a sudden, whereas in Kumo Space, the meeting ends and it's very natural and organic. People will catch up and have their small conversations. And as we all know, that's where a lot of the real value in a company is built. It's in the small ad hoc you know, conversations that happen throughout the day. And Kumo Space just facilitates that. So we actually have less meetings on our schedule. If you look at my schedule, it's virtually empty. And that's because I don't need to schedule meetings. My team knows where I am and they can come get me anytime they need me.
Sounds like it's also a good way for a manager to see if their employees are maybe getting manicures during work time. I have some friends that I know still work from home, and it's amazing what you can get away with. But I will say, you know, you already called that Zoom is on its way out, but just in terms of your forecast for what the future of work actually looks like, is it hybrid, do you think, or do you see a time that more and more companies will be not forcing their employees back to work, but going fully remote?
Well, if you'll permit me to address your comment about nails quickly, you know, of course, some folks are not being as productive as they could be, or they're moonlighting, and everyone, you know, I think often thinks about this FaceTime element of a product like Kumo Space. But I just want to highlight the flip side, which is we've also heard that it's really hard for young employees to get their footing and their grounding in a fully remote or distributed environment, right? They don't have access to the same mentorship that they might have in an office environment. And particularly if you're using, you know, Gen 1 tools like Zoom or Slack. You know, one of the great benefits of Kumo Space is that managers are available for their teams, and particularly for young employees, it's a way to get mentorship. So I want to point that out, and that'll tie into kind of the second half of your question. You know, where is the future of work going? we're the first people to say that of course there's still a great opportunity for in-person, for working and collaborating in person. We go to events, we host offsites for our team a couple times a year to build that bond. We just think that the model should be flipped. So rather than spending, 3 or even, 5 or even 3 days a week in an office, sitting there on video calls with folks that aren't in the office, or on video calls with folks that are in the office that's across the country, we spend maybe once a month doing that, or once a quarter in person, really getting to collaborate in person. And then the rest of the time, we're taking advantage of technology. We're saving 2 hours a day on our commute. We're spending more time with our kids. We're getting to travel and see the world. And we're giving more opportunity to, historically disenfranchised groups that didn't have that same access. And so that's the vision we see at Kumo Space, one where you don't have to compromise between getting work done and living the best life you can live, and spending time with your kids. And anyone who's interested in that future, I encourage you to check it out. We're happy to give you a tour of our office.
All right. Well, all fair points. We really appreciate you making them. Brett Martin, Kumo Space, thanks so much.
Thank you so much for having me. Have a great day, and good luck with the flood.
Thank you. I envy your commute. Coming up, it's time for Options Corner. Alex Coffey will take us through a few trades that stood out to him in today's session. We'll look at trades in GM, Nike, and Carnival. Market on close. We'll be right back.
What's up, Dink? Good, man. Trying to sort out this end of day on SPY. Sketchy last 30 minutes. Jay. Nice 2 pair. Let you see the turn. Let's go dink. Wish I hadn't do any trades today. Big slick.
Investing today with George Tillis. It's almost like a dripping faucet that just isn't quite stopping. You can see we're on the year-to-date lows here, Caroline. This is largely going to come down to how long these strikes last. And as they continue to escalate, it increasingly becomes a bigger and bigger problem. But as that escalation takes place too, it increases the likelihood of a negotiation taking place. So not surprised as of yet to not see a ton of downside, but that could ratchet up if this continues for much longer.
All right. Yep. Shares only down about 0.4% right now. All right. You also took a look at Nike. Shares up still about 6.5% right now, but looks like someone's betting on a pullback there.
They are, yeah, and this is an interesting one because largely the pop in Nike wasn't associated with a blowout earnings quarter or anything along those lines. Really, it was just better than maybe the worst case fears given all the negativity that had built up in Nike. This particular investor saw this as an opportunity to increase their bet against the stock on its pop. What they're looking at doing and what they did was buying 1,475 of the January 2024 85 strike puts for $1.45 debit for each one of these. So the total risk on this trade was $213,875 with a maximum possible profit. Of course, the caveat being on this number, the stock goes to zero in this time frame. $12,323,625. Break even though $83.55 at that January expiration date. So they would really need some downside to take place. So one explanation for this could be maybe a large shareholder looking to hedge their downside in a position, or outright speculation betting against the stock after the earnings pop.
And we have seen some price targets be scaled back after that mixed earnings report, but I was talking earlier today, the median is still 120.50, so it doesn't seem like the majority of Wall Street analysts are expecting this broader pullback. And one might argue we've already seen the pullback in Nike.
No doubt. You've definitely seen weakness in this stock, and this is a big theme of what we talked about on Next Gen ahead of this result was analysts piling on, downgrading, cutting price targets ahead of the earnings. The stock selling off from the upper 90s down closer to 90. And one of the things I kept saying was this report doesn't have to be that great for it to be a surprise to the upside at this point, and it seems to be that was what was delivered. Keeping guidance where it was, inventory issues getting a little bit better was just enough to give this stock a nice little lift.
And lastly, you've been taking a look at Carnival, which has been under pressure this month, off about 14% this month, and certainly not helping today, off about 5.5% after earnings. It has been an outperformer this year, but you see someone looking for a bounce back?
Yeah, maybe taking opportunity for many reasons. One, the pullback in the stock now post earnings, a lower price name, so possibly some leverage factor there as well. It tends to trade with a little bit more volatility, but it's also been very, very correlated as of late to the price of crude oil. So there could be speculation on that front using this as a potential proxy within the publicly traded company world. But nonetheless, we aren't in the brain of this particular trader. We just see what they did. They went out and bought 3,500
one called.
Of the October 13.5 calls for a 60-cent debit. Break even on this is 14.10. Total risk on the trade 210,000. Unlimited upside because they are just buying that call, Caroline. But no doubt taking opportunity, waiting till after that earnings event, doing this morning when the stock was a little bit under pressure.
Yeah, earnings certainly didn't impress investors today. Shares off about 6% right now. Alex Coffey, thanks so much. Coming up, we'll wrap up the week in commodities and look at the moves we saw in crude oil and the dollar. That and more coming up next on Market on Close. Stay with us. We'll be right back.
Minutes to go. Spy's getting a little jumpy. Portfolio rebalancing end of quarter. Last 20 minutes for barbecue. Interesting to think about. Bon voyage.
Welcome back to Market on Close. I'm Caroline Woods in for Oliver Rennick. Let's discuss the commodities market with Ryan Gorman, market strategist at Blue Line Futures. Ryan, thanks so much for joining us. Great to have you.
Yeah, thanks for having me on.
So before we actually get to commodities, your title is market strategist, so I'd love to get your take on the overall market and the volatility that we've seen this week. NASDAQ and Russell actually could still pull out a positive week, certainly not positive month. But what's your take on the weakness that we've been seeing?
Yeah, absolutely. Well, I mean, you're seeing a lot of weakness in the equity markets kind of across the board. If you're looking at like the S&P and the NASDAQ, and we touched on this, before, but, September is typically a time where we see markets retrace a little bit. So you're seeing additional selling pressure out of some really strong resistance pockets. And, the market, had been a little bit overbought. So seeing it come down a little bit, isn't too surprising. We've been indicating this in the research we've been sending out to our clients pretty specifically. So seeing these, U.S. stocks kind of settle down a little bit this week really is no surprise, kind of what we're looking at as we're heading into Q4.
So you're looking at this as just some healthy profit taking?
Yeah, that's definitely part of it. I think the market needed to cool off a little bit. I mean, the last 2 weeks even are typically, the time where we see the most selling through that September, downtime that we typically have. So I think what you're seeing here is, a little bit of profit taking, and, you're seeing a lot of shifting today. I mean, if you're looking at, other markets, bond markets waking up a little bit to wrap up the week, if you're looking at treasury yields off their highs a little bit. So there is a lot going on in the macro landscape. And I think a lot of it has to do with, today being end of month, end of quarter. So you're seeing a lot going on, a lot of funds kind of tighten up the positions they have on.
All right, so I'm taking a look at the S&P sector breakdown. Energy, the only positive sector for the S&P in the month of September. No surprise there. We've seen oil prices tick higher. Talk to us about the move. It looks like we're going to close off the highs of the week, but still trading above $91 a barrel right now.
Yeah, so we touched on this, a couple different times as well. Looking at crude oil has a lot of legs under it, a lot of bullish sentiment. And, a lot of people, I mentioned a few weeks ago when I was on the show, a lot of people like to throw out that big number, $100 crude oil. Well, there is still a lot of points that we have to chew through to really make that next break higher.
10 minutes Fugazi.
93.56 is a
Last
strong
10 minutes of this
point
quarter,
that we've
last 10 minutes
to
of
chew
this
out above, and then getting to that $95
month.
barrel level is going to be key to kind of take us to that next
Market.
leg. But seeing crude, close higher.
Maybe the last 10
again,
minutes of
really,
barbecue
no
shareholders.
All right, so 93.56 and 95. But do you think we can get to 100?
Yeah, I mean, it's in the cards. Absolutely. I think, if we have conviction and this market, we don't have a big catalyst that sends this thing lower, there's a lot of legs behind it. People want to be buying crude oil. Anytime the markets come down a little bit, then people want to be stepping in and buying this product. So I think if we can really chew through that 93.56 with some conviction, inch out towards 95 and see where we trade from there, if this thing can hold up strong and constructive on a closing basis, wouldn't surprise me by the end of the year if we achieve that $100 a barrel.
All right, next up, the dollar. Talk to us about the move we've seen there and where you think it can go from here.
Yeah, so the dollar, it's been explosive, to say the least. It's been ripping higher, and they say if you get the dollar right, you get a lot right. You can look at bonds, you can look at yields, you can look at the metals, but the dollar really broke out. 105.15 is a huge level for the dollar, and since we broke out above there, was acting as a big resistance point. That's going to act as new support. So even if the dollar does come down, I got my eye on that level. I want to see if that level can get held, or if we're going to break down below there as we're moving into Q4.
All right, looking ahead to next week, new month, new week, new quarter. What are you expecting? What are you watching for next week?
Yeah, well, looking out to next week, I mean, we're going to see a lot of different things happening. Like I mentioned, you're seeing a lot of the winners for Q3 are losing today. Crude oil's down a little bit today, still strong. Bonds are waking up a little bit, like I mentioned. So bonds have just been grinding lower. So, if we see bonds wake up a little bit in the fourth quarter, that could really help boost, a little bit of a, Santa Claus rally, they say, for some of these equities as we head out into December.
All right, we'll keep an eye on that. Ryan Gorman, Blue Line Futures, great to get you back on the network. Thanks so much.
Absolutely. Love coming on. I appreciate it.
Have a great weekend. Coming up, we'll close out this market session and get the big picture from the team at Charles Schwab. That's next on Market on Close.
10-3. BEA beautiful. SPY's ripping up a little bit. I'm selling some more calls here. Did he stop? Oh no. All right, here comes Fugazi. There's some high variance poker. You know now, boys. There you go, look at that SPY rip. Selling some more up here. A little more. Maybe I'll hold the last 5 till Monday. Yeah, I've seen the end of the perfect storm. I'm all right here. Yeah, I took the L. That hurt. Oh well. L.
Up. It's not quite at the highs anymore, which was what, over 4.6% this week, but still really marched
going
higher
there.
this week.
Did make it to
move
VWAP.
into perspective for us. What's the key takeaway there?
Kind of a dice roll. I don't play Fugazi.
So Cooper, we don't have your audio season. I can see your lips moving, but we can't hear you. So while we try to adjust with that, Nate, let's actually go back and talk about some of the seasonality factors while we try to get this worked out. Because September, it certainly wasn't a month to remember, a September to remember, but seasonally, that's not all that surprising. Now, October, with a few exceptions, some big exceptions, has been known to be a bear killer. Do you think that can be the case this October? Can you make the case that some gains are in store?
Because I could have held longer.
It's really going to come down to earnings, Caroline. It has to do with our current valuation. We're basically at a forward PE of 19, and every time that we see those yields climb a little bit higher and a little bit higher, this is supposed to basically be reflected in a more fair valuation, which is a lower multiple, meaning equities obviously have that inverse relationship with yields. So it's going to come down to yields, and it's going to come down to earnings. So we know that seasonality is very good. We hear the term Santa Claus rally and everything like that. And the good news for the bulls, like I said, there is a ton of cash on the sidelines, but it needs to have a reason to basically get into the market, because right now, Caroline, you get paid to wait and see what happens with these earnings reports. So it's a little bit too early to tell, but right now it's going to be driven by yields. We're going to have to continue to monitor that. The technicals need to improve. We'd like to see the S&P get back above that 4330 level, and then let's hear what the corporations have to say here in a couple weeks, and then we'll have a better sense of whether we can get a Santa Claus rally this year.
Okay, Cooper, let's go back to you. I think that you finally have audio so we can hear you here. Nate was just saying how it all is going to depend on, among other things, yields. I wanted to talk to you about the tick higher that we saw in the 10-year yield this week. What's the key takeaway there, and where does it go from here?
Yeah, sorry about that. I don't know what happened there, but I'm glad I'm back. So I think there's a couple key takeaways that we can look at. One is we look at why are yields moving higher? And if we break down the move in the 10-year Treasury,
there you go, not too bad, exit.
Fed expectations, and I really don't think that those have changed much this week. We're still in the camp that the Fed is going to keep rates higher for an extended period of time. I think that that's what the market's also looking at. We saw some Fed speakers today and the other day speak to the potential that they're done hiking interest rates. So I think that that's something that's notable.
Wow, look at that sell off from VWAP. That's a proper 10 minutes of Fugazi.
Changed too much. We saw the numbers come in this morning, and that points to some trending down towards that 2% Fed target.
Imagine trading next week without barbecue.
So that's a positive thing. So
yeah, pretty easy actually.
Catch-all is what's going on with some of the move up in yield. Could be potentially an increase in supply, some concerns that maybe growth is going to be higher than expected. So I think that there's a lot that's out there. The second thing I'd say as far as kind of what the big takeaway is that now investors can really earn attractive yields on their fixed income portfolios. We think that it's a opportune time to lock in these longer term yields because we do think the Fed is going to be cutting rates eventually next year.
Computer just started going really slow.
We do still expect
wow, look at that candle.
So we are suggesting to our investors, Caroline, to lock in some of these attractive yields, extend duration, and take advantage of the move up in yield.
Crazy.
We saw the 10-year, like you said, a big move up. It's now
definitely
the
some
highest
rebalancing,
that it's
I
been
think.
since 2007.
Wow, yeah. All right, so Nate, in the nearer term, obviously earnings are the next big market catalyst in your view, but next week we do have the jobs data, assuming that the government actually isn't shut down. That could change if we do see the government shut down. Oliver was making the case on MTL that maybe it wouldn't be such a bad thing for the government to shut down because it'd be less data to kind of confirm higher for longer rates. What do you think?
Yeah, I mean, if you look at the initial, kind of more the leading employment data, it's those initial claims. And we saw, 2 weeks ago, it was 201K, revised up to 202K, and then it was 204K this week, both coming in well below estimates. That 202 figure was the lowest since January. That still speaks to a tight labor market. I think the Fed has kind of been okay with having this tight of a labor market. They want stable employment. They would like to see some slack there, but they're more focused basically on that trajectory of inflation. And I think, even if they are done with raising rates at this point, the question is going to be, for how long are they going to keep the restrictive rates in place? So how long is this 10-year going to be hanging out around here? Because let's keep in mind, you know, the higher oil prices, that's a tax on the consumer. Yes, that will be
fold?
good for the energy sector in terms of corporate profits, but then the higher
I was hoping he would
rates
call and
are
I could get his
also a tax
chips.
on the consumer as well, in addition to the
Got 30
corporation.
million.
So it's going to be, you know, how
From
long
this guy
are
just
we
going
going to
all
be
in
hanging
after
around
one
this
after another.
restrictive policy, because that's directly correlated to how we can then justify the valuation on equities.
All right, 3 minutes.
Going back to the government shutdown
Back to
for a
all
second,
in.
though, we know the Fed is very data dependent, and if the government shuts down, it won't get those key jobs and also inflation data that it needs to dictate policy. So what could the impact on the
Dude,
Fed
the
be?
bells out there going crazy at the stock exchange.
You know, I think that if you look at what the impact on the Fed could be, I think that it raises the bar in terms of another rate hike. The reason I say that is that let's assume that they do go through with another rate hike this cycle and the government's shut down, so we're not getting those data points. I think that that would be highly scrutinized and kind of looking at it and saying, well, how can you increase interest rates when we really don't know exactly what's going on out there? So in totality, I think that it just raises the case.
All right, guys.
The
Not going to do
potential
the
that
trades
they're
today.
going to continue to
Too
hold
exhausted.
these levels.
All right, well,
Yeah, not a great day. I'll probably review them on my own, but buy down 0.27%. Big day today. Big intraday sell off, bouncing in today. Still kind of retracing this sell off we've been having. I think there's still more upside to that. Barbecue potentially final day of its existence. 76.9, down 27% today. GME down 2.25, and still below that resistance. AMC kind of pinballing between its wedge still, so let's see where this one goes. Bit of consolidation. Not a whole lot else I did. Closed out of some of the Theta Farm today. Small profits, but profit nonetheless. Make sure you're liking the way out. Have a great weekend, guys. Have a good end of your month, end of your quarter. Government is shut down, not until midnight, I think. So we've seen it come in the last few minutes. Ice cream cones. Made by losing left testicle? Yikes. Taking 3 minutes. But your weekend. Bubbalicious, thank you so much, man. I appreciate it. Thank you for all you do. Have your best live trading stream on YouTube. Thanks, Bubba. I hope I don't steer you off. I know sometimes we're conflicting because I'm not always going for puts. So you're doing good. Doing good. Appreciate your generosity, man. Glad you had a good day today. Glad to hear. Glad you can stay focused. Block out the noise. Thanks, Dink. Thanks, Christopher. Like a train. And there we are.
Get nuts!
Let's get nuts. What guys got going on here? Thanks again, Bob. I appreciate it, man. Thank you all. Thank you for your likes. Thank you for your support today and this week, this quarter, month. Got 15 likes on the day. I appreciate it. And pizza party engaged. Have a good weekend, guys. Be safe. We'll see you right back here on Monday for October rating. Wow. New quarter. Q4 coming in hot. Thanks, guys. Have a good one. 100 a week. Well done, Bubba. All right. Peace out. Peace out.